in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan, as we take you through the rest of this trading hour. Futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tasty Trade. If you're on the website, tastylive.com. Thanks for joining us. Come over to YouTube. Tell us what you think of today's action. This divergence in stocks. We start off the second half of the year with small caps outperforming everything else. The Russell 2000 is your leader, up by 0.96%, trailed closely by your Dow Jones, up by 0.94. Not necessarily joking about Elon getting deported. Something that I've talked about this morning, and as we go to our charts, we see that Tesla is our major underperformer on the session, dragging down the NASDAQ here, off 5.34%. Just another episode in idiosyncratic risk for one of the NASDAQ's bigger components. But regardless, it's a fairly quiet day here overall. Volumes are light. Volatility is staying down. We did have some economic data this morning. JOLTS report for the month of May came out, and there were a lot more jobs than people anticipated. Bonds notes take a little bit of a dip lower over the course of the day following those figures, but I guess higher yields for the right reason. Metals keep surging, which is fairly typical for July and unfun for someone who recently got out of their gold long calls. We find ourselves looking at oil continuing to meander around and a dollar attempting to scratch and claw its way back with a minor doji candle today. Gentlemen, for all of the warts that the first half of the year had, the second half year starting off with an interesting start. We haven't seen small caps lead the way like this in some time. Although we are off the highs. It was a 2+% gain, 2.19% at the high. We're now only up by 0.97%. Ilya, what gives? Is this excitement over Trump's One Big Beautiful Bill Act that was passed by the Senate today, thanks to a J.D. Vance tie-breaking vote?
I mean, I don't know if excitement is how I would put it. It certainly seems to suggest that there is a reshaping of U.S. fiscal priorities, because if you look at what gives us the kind of scratch on the S&P that we see, it's breaking out into Russell higher and NASDAQ lower. So it looks like there is a shift in the kind of things that the government is going to prioritize fiscally. I mean, obviously for small enterprises, tax cuts being made permanent is a good thing. For tech, the scrapping of EV mandates and sort of adjacent things is not. And frankly, the tax cuts don't really make or break their situation. They're not exactly known for massive outlays in this space. So we have a kind of wiggle here. I mean, I wouldn't make a whole lot of it. If you look at what the Russell is doing here, and I think you have it right on the screen here, we're sort of testing the underside of this congestion area, let's call it around 2,200 to 23 and change, just under 2350. It's tempting to say that this, as you have it outlined here, is something of a head and shoulders, where you then have a significant climb that would be implied. It's tough to say that we've confirmed it because the neckline's kind of muddy. There's a bunch of stuff underneath that range where you have some long wicks, some different areas of congestion. So we're in an area of chop now, and so we'll see. But if sentiment gives way more broadly, this setup isn't going to matter. These nuances aren't going to matter. So if we're going to have a climb for risk, it'll happen everywhere. And if we're going to get a sell-off, it'll happen everywhere. I don't think these differences today are anything to extrapolate forward. Like, I wouldn't be putting on a long Russell, short NASDAQ spread here, let's say. I would be either making a bet on risk going up, on risk going down, or not making the bet, because it seems like a macro kind of an environment in that sense. My bet is to obviously fade this, as we've talked about. I basically saw the risk reward as attractive, if nothing else, at the highs here. As we start a new quarter, we're at the highs. The market clearly seems to have fully kind of shed its sentiment hang-ups, but maybe not the growth ones. And I think that'll be the story for the second half of the year. But if I was going to lay out that kind of exposure to basically say the risk reward is better to short than not, it wouldn't be in Russell on a day like this. It'd be in NASDAQ and the S&P, which is where I'm at.
Dylan, with this outperformance in small caps, one can't help but notice that it's something like regional banks driving us to the top side here, higher by 3.43%. Dylan, banks are up, home builders are up. We can look at something like industrials, which closed at a new all-time high today. Aren't these all good things?
This is home builders is actually an interesting thing, which may have nothing to do with Washington and everything to do with the rolling back of CEQA provisions in California.
Oh, well, we can talk about that glorious YIMBY development soon. But
my favorite real estate anecdote is in Manhattan right now, where they made buy-side rental fees illegal. And,
yes.
and the buy-side rental fee is 15% typically. And immediately all rents in Manhattan just went up 15% because now it's a sell-side fee.
Yeah, so like my wife works in real estate, so the way this was worked out is, okay, so the landlord is going to pay the fee now to the broker directly instead of coming out from the renter.
Right.
Great. So what does the landlord do?
You could negotiate the buy-side fee down, and now the buy-side fee, now it's actually better for the brokers because there's no negotiating on the buy side.
Because it's fixed into the rent prices.
Yeah.
Just that's what's happened.
But anyway, back to your little thesis here. I mean, I again, the economy is obviously relatively strong. The intermediate and short-term effect of the optimism, just the emotional momentum of the coming tax cuts for the rich, which is going to send all sorts of money flying into the market. I just think that I think the market is set up for lots of strength in the relatively near term, and I think one of the places that it goes obviously is real estate. So, you know, it doesn't surprise me to see some performance there. You know, it's I don't know if I have any tremendous insight, but it for sure is a situation where assets, real estate, stocks, crypto, I think all have a nice tailwind at the moment, and I think the only thing that it could stumble on would be some sort of material economic weakness, which is not apparent right now.
It's not apparent right now, but I think that's actually the most important thing that we can consider for the second half of the year, because what's happened here in the first half is a fairly unique set of circumstances. If you heard me on Futures Power Hour, let me explain today. Forgive me for repeating myself, but different audiences, different time of the day. So this is a rehash. In any event, the first half of the year was only the 9th time in history where the S&P 500 was down by more than 8% at one point year to date, only to finish the first half of the year in positive territory. The other 8 times happened in 1957, 68, 78, 80, 90, 2003, 09, and 2016. And those years produced an average gain of 2% in the third quarter and 5.3% for the remainder of the second half. But the 2 times that you didn't see rallies there, right? So 6 of the 8 times previously, the market has gone up. But the 2 times where the market didn't rally in the second half of the year, 1957 and 1990, recessions were there in the second half of the year. So, Ilya, that actually has a lot of importance for how we think about macro data moving forward. It actually does mean it's recession or bust, or should I say recession or boom in a certain sense. We're either going up because the recession doesn't arrive, or it's going to come here and equities are going to get kicked in the teeth. But yeah, that's not just what we have going into this second half of the year right now. If you go back to the April 6th low that you have in the market, okay, low that you have into the first week of April, you go to a rolling 2-month return where you have a gain at one point in the S&P 500 in excess of 20%, which on a rolling 2-month basis, you've only seen 6. That was only the 6th time in history that you've seen that kind of return. And the 1 month, 3 months, 6 month, 12 months return for the S&P 500 historically have been 8.2, 12.5, 16.3, and 30.8% respectively, 100% of the time. So this turnaround that we just saw in stocks in the second quarter, it's historic, it's rare. Unless the economy keels over with bad economic data, the weight of history suggests that there could be still meaningful gains ahead as we think about how the next few months will plan out. Elia.
I mean, the thing that grabs my attention here is that everything that we've learned about the economy isn't suggesting that it is in fact in an accelerated state. We heard from Jay Powell at the ECB forum in Sintra overnight, and he said the economy is in a solid state, and I think that's pretty accurate. But if you look at sort of the pace of growth, it's clearly slowed relative to what we saw in the second half of last year. That much is unmistakable. The larger issue isn't the slowing, it's what the markets think is coming next. Because the markets are at 125 basis points in rate cuts between now and the end of next year. That's 50 basis points more than what the Fed is forecasting. They are looking at a better than 50-50 chance of a third cut this year. It's narrow, 55%. But what is it that they're seeing that they think the Fed is going to change its mind to this extent between now and September? And does this look familiar? Obviously, we saw a very similar situation last year. It gave us a spill in stock markets as we were waiting for the Fed to cut, and the Fed didn't want to cut, and the markets were screaming at the Fed saying, there's a growth scare, you've got to cut. And last year, that growth scare worked out. We don't know if it's going to work out this year. But what we know is last year, from mid-July and until the beginning of August, stock markets were falling. So, and it was around this story. So if you look at the high for the S&P, July 16th into its low on, what is that, August 5th, that's a 10.5% decline. So yes, July is narrowly positive every July, blah, blah, blah. But if you look at the internals here, last year in July, you have a sell-off. It isn't the sell-off that conveniently falls around the calendar because it starts mid-month and runs for 2 weeks, but I don't see that as in any way a distant possibility here, because what the bond market and what the rate cut pricing is telling you is that the market knows what the Fed needs to focus on, and it's rate cuts, it's growth. You're looking at break-even rates that are back to April levels. So the markets have the same view of inflation here as they did when the whole Liberation Day fiasco was going on. Pretty much. That's not a positive story. That's the market saying there is an economic downturn on the relatively immediate horizon.
Dylan, you were talking about this economy running hot and Trump's big, beautiful bill. I obviously have a very dark way of looking at it if we're going to make it market oriented, but I'm curious about your take on everything you know about how it could impact stocks and the broader economy.
No, I mean, I was just saying it in our discussion with Tom and Tony. I mean, when you add more, when you give more money to the richest people, it's not, they just roll it into real estate and equities. And so I don't see how this would be any different. It's not like the whole idea of trickle down economics, creating widespread economic benefits, has been objectively disproven for decades. The only thing that happens when you give the wealthiest people more money is they invest it into real estate and financial assets.
Real estate.
So it just seemed would be a good, if you're going to have a big, beautiful bill that gives more money to the rich, you would think that it would be net positive for real estate and financial assets.
Good for real estate financial assets. Yeah, it's one of the reasons why we had some of these REITs last week, which fell on Mamdani's primary victory in New York City. They've since started to bounce back.
I mean, the Russell's performance today speaks to exactly what Dylan's talking about.
Well, here's the thing. If we look at the one big, beautiful bill, there are substantial Medicaid funding cuts. We're not here to talk about the morality of them one way or the other. But the reality is that if Medicaid funding cuts ultimately do go through in the provisions that they've been passed, you're probably looking at healthcare providers in rural areas in red states getting hit particularly hard because those states don't tax their population to help pay the costs of those types of activities. Hospitals in red states are heavily reliant on Medicaid funding to stay afloat. So if we're cutting that kind of stuff, it's probably going to have negative downstream effects. Dylan, there's part of me that thinks maybe the way to go about this is to look at companies that rely on Medicaid reimbursements for hospitals in some form or fashion, home health care providers, hospice providers, long-term healthcare providers, company like Amedisys, for example, excuse me, they are down 2.04% today as this bill passes. It's not the most fun way to trade. No, LHCG is what I'm looking for. It's not the most fun way to trade. You're not pulling up for me here, but it is just a reality of the situation that we're in. If these companies are going to lose federal government funding, they're not going to be as profitable moving forward. Why shouldn't we take advantage of that in the market if the market's going to afford it to us?
I think that we should. I mean, you're asking a rhetorical question.
Am I? Should we short these health companies because hospitals in rural America are going to shut down? Is that the play?
I wouldn't connect that dot so quickly just because I think there's a lot of sort of contingencies in there. But
So
I
work
do
through them.
Well, so let's say you're going to shut down the rural hospitals. So you're suggesting then that the revenue from the rural hospitals will be eliminated from the income statement of the publicly traded healthcare companies.
Yes, they will not be reimbursed for the money spent there.
What percentage of the revenue? Maybe that's the least. Maybe that's the lowest yield revenue they have.
They also
probably make much more
added
money
a special
in Manhattan
provision
and San Francisco.
here.
Sorry, go ahead, Ilya.
No, I'm just saying that they also added a special provision to address exactly Chris's concerns. And by all means, do remember that I am very much a tourist in this space because I did not read the whole 1,000 pages that this monstrosity was. But from what I'm reading, the concerns about rural hospitals are very much something that was on the front of people's minds, and to placate Alaska's Lisa Murkowski and get her to vote on this thing, they added a special provision in the bill with, if memory serves, a $50 billion fund specifically to help support rural hospitals.
Do you hear how stupid that is? Do you hear how stupid that is?
Yes. Yes.
So instead, we're gonna cut funding for them, and instead of giving them the money directly,
on the other hand,
we're gonna put it into a bailout fund.
Yes, we're gonna take money from our right pocket. We are then going to put it on the table next to us, so that we could put it in our left pocket when inevitably the time comes.
Right. States, a lot of red states set Medicaid reimbursement rates. They are able to reimburse through federal money. We talk about, hear about block grants, for example, and then the states administer the policies they see fit. The pool of money available is shrinking. So provider services will be neglected. They will decline in quality. They will cease to exist altogether. Having had conversations with people in my area, there are 2 hospitals in my area that are potentially going to shut down as a result of this particular bill. One is across the river in Rockland County, Montefiore, Nyack. The other one is a little bit north of me, Putnam Hospital. It won't impact me directly. Although if hospitals are shutting down, like what about the one in the town over from me? That's probably going to see more people. Do I want more people going to a hospital in, say, October or November when my wife's due? Would I want those resources strained? So I'm against this. I'm against having a crowded hospital in there to welcome the newest member of the family in a few months. That's not really my cup of tea. Dylan, I know we've talked about these issues before, like, the insurance ETF when it came to those California wildfires. And look how quickly they bounced back at the start of the year, right? I mean, this is bulletproof, this thing. You get a big decline in insurance ETFs. There's a structural advantage in here where you just can kind of sell the vol, sell the puts, and churn higher. It's almost the exact opposite scenario here now for a lot of these healthcare companies. They no longer have the support. It feels like they now have a ceiling over their head that's going to increasingly make life difficult here henceforth. They've lost their monopolistic ability because the till is now closing, for right or for wrong. That seems immensely thematic, something that we shouldn't ignore.
But I would argue that the thematic of demographics overwhelms any sort of restructuring in the. Just because you don't have fewer hospitals doesn't mean you have fewer people who need medical care.
Exactly. But the hospital chains, right? Like I'm thinking of the New York City metro area, a hospital chain like a Northwell Health that has tentacles that extend into the suburbs is a lot better suited to handle this than a hospital chain that starts in a rural area and is creeping out into the suburbs itself, right? Because it doesn't have that core population base from which it can always rely upon, including a mix of private and people holding insurance or people who are holding private insurance to offset those costs.
Well, you know what that sounds like? It sounds like consolidation and inflation.
It sounds like that's the other side of this, right? Because Dylan, you mentioned that people are still going to need these services. So it means that some service providers will have cheap M&A opportunities. There's probably 2 sides to all of this. The first trade is some of these companies are going to get hit really hard, but people are still going to exist. They're still going to have healthcare needs. They're still going to need treatment. They're still going to need long-term memory care, right? And so that means the bigger companies that are able to survive without the Medicaid funding, you're actually provoking concentration within the industry, and you're then incentivizing a wave of M&A activity down the line. So up front, I think you could be bearish on some of these companies if you're looking at the one big beautiful bill on this very idiosyncratic basis. But once we see a little bit of weakness and creaking in the system, I don't think that we can rule out that it's worth looking at some of the beaten down companies as flyers, right? Like, well, who's going to pick up their buck? Someone's got to pick up their buck. They probably can be bought out. I digress. I'm looking for a trade opportunity within this one big beautiful bill. And the Medicaid funding cuts seem like the most extreme opportunity where you're going to less balkanization, more concentration. So companies will fail. Others that didn't get hit particularly hard today are probably going to be the ones that stick around for a little while longer. So healthcare operators in urban areas probably better off than healthcare operators in rural areas for the foreseeable future. And that seems like a silly thing that we'd even talk about here on Overtime, but it's that kind of quiet day, guys, where we kind of got to go into the weeds on something unique in order to push through for the full hour. So that's
then would you rather, I mean, so it's like if you're going to go down that path, I'll come on this journey with you, good sir.
Thanks.
Do you strap on the shoes? Is the play way to do this to make a basket of distressed targets that are high probability to be taken over because they can't function in the new revenue regime. So they're either going to have to sell, go bankrupt, or shutter their doors. And then those who are the least affected in the wealthy cities can just acquire the best of the extended assets and increase their monopolies.
That's what I would think. That's one of the reasons why I brought up this company AMD here, or AMED, Amedisys. About 20% of their revenue comes from Medicaid, a hair underneath that, and 70% comes from Medicare. Their payer, that's crazy. This is a company that without government spending just doesn't exist, right? And we're seeing substantial funding cuts to something of this nature. I think we have to be, if we're going to look to the big, beautiful bill. So let's just separate this into two things. If you are a typical tasty trader, you probably don't care about a single thing we're saying here. But every now and again, we like to pull something unique out, a different way to look at the market, an AI basket, what's happening with insurance companies after wildfires. Today, we're talking about this bill because it did just pass the Senate. I would think that, yes, Dylan, there are targets that we should look to that are probably weaker along the way. But if you were off 2-3% today, the market is giving you a very significant warning that without external revenues or new funding sources, the residual value of this company's equity is going to be materially harmed, potentially forever moving forward. And I know it's a stock that just a few days ago was sitting near highs, but a few days ago it looked like the Medicaid cuts wouldn't make their way through the Senate, and they just did. So it's a different ballgame now. The point, though, I want to get to is try to figure out a way to sell this.
Well, so, and this is my question for you. When it comes to these kinds of thematic things, I mean, I have a thematic view on Brazil, as we've talked about. It's not 45 days in, 21 days out trading vehicle kind of a view. And by the way, it's working. Brazil is rallying, but it's a thematic longer term view. So all I did was just buy a leap, and that's it. I'm not touching it. It's sitting there. It expires at the end of the year. On we go. For a trade like this, where you're saying, okay, you're going to have the bill ostensibly passed something close to what the Senate just did. And I think that there's a pretty high likelihood there that the president's weight in the conversation is so significant that the House will, despite objections, despite the fact that there's very little wiggle room, despite the fact that a bunch of people in the House don't like this bill on the Republican side, they will ultimately say, you know what, July 4th is coming up. We said we'd get it done by then. And they do it. How long would you structure a trade here to take advantage of the disruptions that it might cause for some of these regional healthcare operators? I mean, surely we're not talking a 45 DTE type of cycle. We're talking longer than that.
Oh, yeah. For sure. Like Michael Burry kind of stuff.
Yeah,
pulling your hair out.
This is years. This is going to take years.
Maybe it takes years. But, this is also why I have something like this in the back of my head. If I want to be a raging bull, Dylan, I got to think about ways I can bring down my beta weighted deltas in my equity trading, right? So I'm not just on tilt all the time. I'm not just like, I got to chase this higher. I got to put more on. So if
there's the rub, folks, that's exactly where I was trying to take this.
So if I want to still lean long stocks in July, because this market has done something incredible over the last few months, historic even, and July has been good for whatever rhyme or reason, I want to keep betting on black. That's just who I am. I'm a momentum guy.
I couldn't agree more.
There have to be.
I guess the only question is, let's assume that that's the premise. Then the only question is, where is the best pop or probability of profit or risk reward for that black bet? That's one thing to say. Where where is it? Is it in an index? Is it in a sector? Is it in is it in crypto? Where is it?
The ETFs that would be related to this, like healthcare provider, IHF, that's a really thin That's a really thin, 200,000 today. You look at the uh, volume. There's no volume in this ETF. So, I mean, we could do something like this, but I think you'd have to go to an individual equity name. I want to put just together a small basket of like three names, like Ahmed, Ensign, and then maybe one of the actual senior living facilities. I have to look through their balance sheets a little bit more, but going on to a new theme for 3Q, bullish on the indexes, short home healthcare providers in areas that are likely to see significant funding cuts as related to this bill. So Ventas is one of those companies. VTR is a healthcare REIT, if you will. So these properties are obviously tied to these are leased to operators, and the operators make money by getting reimbursements from Medicaid. Really, if there's like a commercial real estate place to look, maybe look commercial real estate related to healthcare facilities. If we think the bite of high rates is still going to come through the pipeline, it's a factor exposure weighted tilt is what I'm getting at. So I'm going to line some things up for tomorrow's show. I really like the decline in Amedisys, down 2.25% today, and then we have Ensign here off that's 2.25%. But double top potentially in play, breaking up trend. It just lost its 1 month moving average for the first time going back to the end of April. It's an ugly duckling on a day when you had the biggest outperformance in small cap and value over mega cap and tech since the election.
Yeah. Yeah. I mean, for me, the larger question is from a macro and from a growth perspective, does this extrapolate out? And I'm not sure. But what it does seem to me is that from an inflation perspective, it does. Not near term, perhaps, but this is one of those things that kind of gives you the sense that with consolidation and market power, there will be higher prices. With higher prices, there will be greater costs. And that's greater costs for the public purse, just as it is for consumers. One of the great ironies of this may be that actually cutting Medicare will mean that healthcare, even as paid by the government, will become more expensive because the providers will have greater market power as a consequence of this. There's a lot of talk about insurance company gouging, but it pales in comparison when you look at some of the numbers at hospital gouging. And so there's been a lot of very interesting studies on this that The Economist has summarized really well. That we talk a lot about the cost of insurance in the U.S., but what we don't talk a lot about is the cost that hospitals extract for procedures and equipment and things like this. You consolidate hospitals, you consolidate market power, you raise prices. And that sort of fits into a narrative of higher interest rates for longer, which obviously in both real and nominal terms is a weight on the economy. So, and a weight on public finances, which already are getting a $3 trillion-ish move in the wrong direction as a consequence of this bill. So more debt financed at higher rates. And there's not a thing that the Fed could do about it, despite what the president says, because these are longer term considerations. This isn't anything the Fed could fix by cutting rates by 50 basis points tomorrow, or even 100 basis points tomorrow, if they so chose.
Dylan, you seem not to be worried about the economy here. Why not?
I mean, I am worried about the economy, but I feel like I'm trying to be stupider than I've ever been and just sort of take things, as at their face value. And if the story is more money available for rich people, that is positive for things that they buy. you know, I think that the underlying and there's 1,000 underlying, stories which we sort of haven't really ground into much lately because it gets repetitive. But the tech piece and the finance piece and the all the pieces of this thing are intact. And so you're kind of left with the only thing you're left to debate is, will the economy weaken? What does a weaker economy mean? A weaker economy means less jobs, but I think even that's going to start, or excuse me, more unemployment. But even that's going to become increasingly, hard to discern, especially as AI sort of comes through. Obviously, what we're going through here is the largest consolidation of wealth in the history of the world for the smallest group of people, and those people are going to own most of the assets. And as they get more money and own more assets, those things will go up. And if society collapses, who cares?
You're doing the New Yorker cartoon where they're all sitting around the campfire in tattered clothes. It's like, yeah, the world ended, but we did get great shareholder returns for a little while.
Yeah. And that's kind of how I see it. I'm not saying it's so extreme as that, but it's certainly the probability of social suffering is going up, and the probability of massive wealth concentration is going up. And massive wealth concentration always circles back to rising real estate and stock prices. And again, the only thing, is like, I think we do ourselves no service to evaluate the stock market as if it was a rational environment driven by some sort of connection to the real economy, when it's increasingly not been the case. And I think you have to let the stock market be what it is, which is a reflection of the available free cash flow to the wealthiest people in the world. And if there's going to be more free cash flow for the wealthiest people in the world, I would think that that's pretty good for the markets in the short term.
Well, and therein is kind of the key question is, does this amount to more cash flow? Because one of the interesting
and
things,
also what is short term, I would say,
and also what is short term, absolutely. Yeah. So one of the most interesting things that, if you're paying attention to macro nerdy things as I am, that's been happening in China is a really interesting cautionary tale. China has been attempting to create more free cash flow to get their economy to have demand for the better part of 2 years, a little bit more, in fact. But let's say we'll go to the beginning of 2023 as the start of their reopening from COVID restrictions. And if you look at surface level, there's even an improvement in the share of new loans as a component of GDP. So ostensibly, the people are taking the signal. They're borrowing the money. Problem is, they're not spending it. If you look at the data from the central bank in China, you see that all the money is going into what are timed deposits, which is essentially their version of a CD. So they're sticking all the money into savings. They're not actually laying it out because they have no confidence in the architecture of the system. In fact, the confidence in sort of Beijing's ability to keep the wheels spinning were so eroded during COVID that the gap now for how much of the incremental new money that a Chinese consumer or a Chinese household gets goes to savings versus spending is at levels never before seen for as long as the data goes back. It's vast. So if there's no confidence, then the money's not going to get spent. These tax cuts, they don't really create much new money. They lock in tax rates that were passed in 2017. it doesn't really look to me like this is creating a lot more money in
That's also
people's
why.
hands.
That's also, well, it's not. If you're in the top 20% of income earners in the country, you're going to see you'll see after tax savings. It really is about the top 10% and really the top 1% that do the best. If you're in the bottom 50th percentile, chances are that this tax legislation actually costs you money per year.
Right. The SALT deduction growing from 10,000 to 40,000, I think I read.
Doesn't hurt
for
me.
House. I mean, that helps. That puts some money back in people's pockets, but it's also temporary. It expires in 2028 again. So we're going to have to do this whole dance again. But for now, I guess this frees up a little bit of money, but it's not anything that you'd think, oh, here comes a big Biden-esque dump of money on the economy. It's going to lift asset prices. It's going to boost growth. That's not what this is. But to the extent that it can be inflationary in some of its other provisions, it might actually make the cost of money higher.
What was Biden's Build Back Better? What did it get whittled down to? $3.5 trillion in new deficits or debts over a decade?
Something I think this like that. This is about the same.
This is about the same, right? I think that's really the important. That's like the important takeaway I have. It's money being
spent.
It's
just a different way to get to a $3 trillion-ish number.
Yeah, Dylan, like the money is going
only
out
with
the
less
door.
growth.
Who's getting the money? What parts of the economy are getting the money? That's different, of course. But the government is still spending money in a form and fashion that a few years ago we said was distasteful because of what it would do to inflation. Or at least that's what I was told. Stock market's pumped since then. Gold's pumped since then.
This is a different spending of the money, though. And this is why you kind of have to wonder whether, I mean, obviously we know the Biden program had a tremendously stimulative effect on the economy, hence the inflation. If there wasn't a stimulative effect, inflation wouldn't have occurred, right? This is sort of the essence of it worked to boost demand or there wouldn't have been inflation. So we know it worked to boost demand because otherwise we wouldn't have seen what we saw. We know, to Dylan's point, that trickle-down economics, which is what this is very aptly named because it is indeed a trickle and nothing more. Because the money doesn't get spent. If you give people more money that already have a bunch of money, their propensity to spend isn't all that much moved. They were going to spend what they were going to spend regardless. The incremental dollar doesn't change their situation very much. So it doesn't necessarily create that much more demand. So it's expansionary from a deficit perspective, not necessarily expansionary in terms of growth.
Dylan, you've had nothing but good things to say about this bill and legislation. Do you think the market cares about it today, or is this just, NASDAQ pulling back?
The market already had it priced. I think the market already had it priced in. I think that the chaos of this thing sort of, remember the whole Musk fricassee with the Epstein and this bill was the catalyst, or the suit, at least the public catalyst for the Musk breakup with the Trump administration. And so I think it was at that point in time that it became apparent that this was going to be the way the legislation was going to go. And I think the market basically reflects it. And so I don't think that this is priced in, as they say.
What do you think of this Tesla situation here? Anytime Tesla pulls back on politics, it feels like a ridiculous set of circumstances. Do we buy the dip here? Is Elon Musk going back to Canada? Is he getting deported?
Yes, you buy the dip, and no, he's not going back to Canada.
No.
You always buy the Tesla dip, and they will never send Elon Musk to Canada.
That's
Those
why
are-
Elon was pushing for the 51st state thing, because he wants to be president.
He wants to be use his Canadian
That's
residency.
an interesting backdoor.
For a presidential to establish his citizenship, his birthright citizenship for the presidency.
I mean, you'd have to think as part of a negotiation to join the union, Canada would be like, all of us, anyone who's a citizen here, naturalized citizen, they're born Canadian, they moved here, became Canadian, they're now Americans if we're coming into the fold. So Elon Musk would be American, so he would be eligible to run for president. I mean, that's what I thought that whole thing was always about. Elon Musk whispering in Trump's ears. Nothing more. But it's back to 300, and I felt like I was, my daughter graduates from preschool. Proud dad here. I'm ignoring the noise. It's June 5th. I'm by the pool. I'm watching Twitter. I can't believe what I'm seeing. I can't believe I'm not on overtime today. I'm texting Victor. We got to buy the dip, right? We got to buy the dip. I get into work the next morning. Westwood was like, oh yeah, I already bought the dip yesterday. And then sure enough, we've bounced 10%, and I feel like I've missed the trade. So Dylan, are we going to make the same mistake we've made the past few times? Or not?
Which
Tomorrow
mistake
morning,
you mean by not buying the dip?
by not buying the dip. Got to buy the dip.
No, we're going to buy the dip. Let's do it right now. Set it up. Call the screen. Let's go.
We're going to go 45 days out. We're looking at this is a 30.5 IVR, $15 wide. That's not enough for me. That's not enough for me. Let's look at the most recent swing low here. We'll call that 273. We can scooch this up. We'll scooch this up a little bit. We'll go 270, 255. You know what? Let's just go, let's go $25 wide. That's a 68% probability of profit. It's 4-to-1 risk to reward. It's not the greatest thing in the world, but money's money. You're basically making a trade that you don't think that the swing lows that you have starting May 1st onward are cleared out. And we know that the previous pullbacks from these levels, from 320 or so down into the 300s, they've been politically induced. They don't stick. I think it's a trade we got to take, Dylan.
I agree. I think I'll do it with you.
This is what they've been forcing me to get long Tesla. Unbelievable. Absolutely unbelievable. Ilya, what's
They
going on?
won't get me.
It's like this. I feel like that meme of the guy looking at the buttons, like, like Musk and, his headache. But he is fighting for this. But he is fighting for, this legislation. And he did get the solar and wind tax penalties removed from the final bill. I suppose that's good. I can't believe we're going to tax wind and solar. For what reason? Why tax them? What's the point? The SALT deductions, like my state and local tax property taxes were $23,000 last year. I can only write off 10. You want to give me the ability to write off another 13? Thank you. Doesn't hurt me. I'll take it. Not thrilled with how the bill looks, but that certainly doesn't hurt this household.
Well, what I'm really hoping for is that they stop taxing offshore citizens. Is that in there?
Hell no, man. Uncle Sam owns you.
Come on, if we're giving things away, what about no stop taxing the passport?
It's not very America first to be an expat, Mr. Radigan. That's explicitly America second in line behind where I want to live now. Oh, did I touch a nerve? Oh gosh. He freezes out on us there, Elia. What can I say?
Well,
Elia, we have crude oil here.
In fairness,
65.
I did not see anything in this bill on expats, but were I to have seen it, it would be both incongruous with an America First policy and not at all surprising, because being congruous is not what this bill excels at.
Okay, so we have oil here. We've made our bones the last few sessions being short, switching to directionally neutral. It's another day where it's pinned right near 65. Modus operandi stays the same here for the back half of this week, a Wednesday, a Thursday that are quieter session, well, not quieter, but limited sessions insofar as Friday's a holiday. So like this is the rest of the week now. the next 2 days.
Uh-huh.
Oil stays here.
Yeah.
Keep going.
I don't see any reason to want to take a bet here at this point. It's not doing anything. My sense is that we should be getting to a kind of growth-minded conversation in oil now that the geopolitics have well and truly filtered out. You see a couple headlines out there today that maybe the Israel-Iran ceasefire is sort of creaking at the seams and might snap, but I don't think either side wants a fight, and Netanyahu is on his way to Washington. Trump was out there today basically saying that his intention is to browbeat him into a ceasefire in Gaza. And it's probably that time now. I mean, essentially the sell that he's going to have to stop this thing in Gaza in exchange for the U.S. directly striking nuclear sites in Iran with only the bombs that we have. Israel doesn't have them. Using the bombers that we have, Israel doesn't have those. That's probably the bargain. That's probably why he's going to Washington, to sort of make this whole thing official. Because the war in Gaza is not a war with Gaza, it's a war with Iran. So now that kind of the big hit directly has occurred and there's been a ceasefire, seems like this is the time to unwind what's occurring in Gaza. So with geopolitics then out of the way here for oil, it seems like this should be a growth conversation, and it isn't surprising then that we're stuck in the same kind of middling area where we were stuck before, because the growth conversation is not making anybody happy. It is neither giving you the kind of data where you go, okay, this is definitely a downturn, hide your kids, hide your wife, nor is it telling you everything is peachy, the economy is going to ramp up and there's going to be more uptake on energy. Obviously, it's not saying that either. So I'm just gonna step back here. I'm happy to have stayed long gold. It's going up for reasons not related to geopolitics here, and much more related to the fact that the market is shoving more and more easing into the Fed outlook. The bonds even attempted to sell off today on this big, beautiful whatever it was, and they couldn't even do that. ZB ends today narrowly on the upside. So I'm going to stay there.
Mm-hmm.
I'm going to stay there, and I'm going to wait for oil to decide what it wants to do here next. My bias would be bearish, but it's got to break some of these levels.
Dylan, I know that people think there's, maybe the economy's not hot. Maybe to end on a lighter note here, Shea Gilgeous-Alexander signed a $364 million, an extension today that brings his total contract over the next years to $364 million. 2027-28, $63.5 million a year. That escalates to $78.7 million a year in the 2030 to 2031 NBA season. How can you be bearish on the U.S. economy if those are the kind of TV deal rights that are coming down the pipeline, which means viewers and advertisers spending money, and advertisers spending money because people are spending money because we're consuming so damn much. But that's a wild side of the times. The other headline that I saw across here, just as we end out, a jury reached a partial verdict in the Sean Combs trial. Do you have any thoughts on P. Diddy or overtime, out of time?
I don't have anything. I don't have anything fresh. New Clips album due next month.
All right.
Well, no, I'm sorry, this month.
Overtime is
it's already July.
We'll be back tomorrow with a full Radigan. Same time, same place. 4 p.m. Eastern, 3 Central, right here after last call. So for Ilya Spivak, I've been Chris Vecchio. Good luck trading after a brief break. Ilya's back. Macro Money up next. Tasty at night.
See you there, everybody.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new tastytrade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? tastytrade. Make your move.
Do you have a long-term trading goal for this calendar year? Do you have any particular trading goal in mind for this year?
I mean, I think you always go into every trade, every year with a goal in mind. I don't put a specific number on it. Take it day by day. I mean, I've never been to one of those alcoholic meetings, but maybe it's one day at a time kind of thing.
12-step program?
12-step program, yeah, 12-step program, one day at a time. Just try to make the most each day. Some days have more opportunities, or at least you perceive more opportunities, and you go from there.
Well, I have a goal. I wouldn't say it's a long-term goal. I have a short-term goal. It's 1 year, yeah. Developmental-wise, I'm past that now. I've reached a point in my life where I can no longer learn new things. I have like a percentage, objective, dollar objective, that kind of thing.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with tastytrade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the tastytrade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
What's the best or worst trade that you've ever made in your life? Like, what stands out to you?
Oh man.
Oh man.
It's a 1x2 call spread that I had in Amazon. It was in 2022. It was during earnings. I was trying to take advantage of a snapback to the upside. So I was short 1, long 2. And if you remember anything about 2022, earnings did not go well for many stocks, and Amazon was one of them. And lost a lot of money on that one. But we learn from these things, right? And so I try to do better next time.
Best trade that I ever made was the first trade that I ever made, and it was a FAS, which is a 3x inverse leverage ETF. And I opened that trade on February 20th, 2020, held it for a month, and I think I made like 140% in like 27 days. And I've never been able to replicate that, obviously. And the worst trade was GME. I lost like $2,000 in a day on GME. Yeah, which is not that bad. Some people had it way worse, but for me, that was my worst. Yeah.
Worst trade? Probably selling a put in Peloton before it crashed to basically zero. I don't even know what a Peloton is anymore. I've stricken it from my memory. Also, Meta. Well, Facebook, before it became Meta, had a strangle on for earnings. It dropped like 60%. Forced to close because I was trading too large, and then watched it rally all the way back. So that's a lesson in sizing. Best trade I've ever made was probably just buying VIX calls before the COVID backwardation that happened. So that was a really nice trade. That was just like a YOLO, like the world's gonna shut down. Let's play a game here.
I would say anything I do in Natty Gas is a losing trade. So if you ever see me trade Natty Gas, take the other side. You will probably be out on top.
NASDAQ futures. Worst day, trying to catch a falling knife there. We don't do that anymore. We trade small, and we try and trade often.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
It is a quiet day for stock markets as the big, beautiful bill championed by the Trump administration clears its hurdle in the Senate and now heads to the House. We get a little bit of a update from Fed Chair Jerome Powell, and we get some troubling manufacturing data. I'm going to try to make sense of all of it here on Macro Money. This is Ilya Spivak, head of global macro at Tasty Live. While we have this opportunity before the next big batch of event risk hits the tape, we're going to try and take this step by step and get into how at least one macro-minded trader, this one, would unpack this news flow on a given day. And the main question that we have here, as I can see it, is whether the makeup of what we saw today suggests that the Fed is right to be as worried as it sounds. Because the markets seem to think that the answer is both yes and no, depending on which worry is in question. And how things are positioning then, and what the markets do across major assets, should be majorly influenced by whether the Fed, at least in the market's estimation, is worried about the right thing. So let's take a look at the price action here. First, we have the S&P here down about that's not correct. It should be 0.09%, because it was nearly flat here on the day, whereas the decline in the Nasdaq really is as big here as it seems, and it's not the biggest decline in the world. There we go. Fixed. That's accurate now. And the S&P, for its part, flat on the day after testing near its year-to-date highs. And that's really on the back, seemingly, of this big, beautiful bill situation. Because what we have once we get into the internals sector-wise is outperformance for small caps, the Russell tellingly higher today by a good margin, adding a meaningful 1% today, and the Nasdaq down by almost an equivalent amount, as we say, 0.89% here. And that breakdown seems to sort of broadly reflect the priorities in this bill, and perhaps the expectation that it is likely to get passed. Healthcare up, financials up, consumer staples up, but technology and communication services, sort of looking at the sector breakdown, both down. So this seems to speak to that impact here. Yields, interestingly, a little bit higher at the front end, but still relatively anchored at the back end. Perhaps this reflects the near-term inflationary implications, at least to some extent, of what we saw in this bill. It is expected to increase the deficit by something on the order of $3 trillion. And of course, that's spread out over 10 years. But one sort of more immediate impact here is an update in the state and local tax deductions. This was a big sticking point after the 2017 tax cut program in the first Trump administration that significantly reduced the amount of state and local taxes that could be written off from federal taxes. And this significantly increases the cap from 10, it looks like, to about $40,000. And so a meaningful increase, and that perhaps puts a little bit more money in the hands of consumers, which may be inflationary in that it sort of gives a cash infusion into consumption sometime next year. So maybe we have a lift in the 2-year that sort of follows along those lines, but the 10-year here is still relatively anchored. Crude oil, despite the marginal increase today, still very much in consolidation mode since those geopolitical tensions washed out of the price. Gold a little bit higher, the dollar a little bit lower against its major counterparts. The pop in gold, in particular, interesting here with yields doing what they're doing. Typically, you wouldn't expect gold to do well in an environment where yields are tracking higher, but the sort of story here seems broadly to follow what's been going on in the yields space today. And that's in the wake of comments from Fed Chair Jerome Powell. He spoke at the annual ECB forum in Sintra, Portugal. And it's an interesting story there because what we seem to have today is a very different kind of a story for Fed policy odds than you necessarily have for the broader yield structure. And of course, there's an impact, but that impact seems to be largely downwind for maturities. The message from Powell was not an unfamiliar one. This is basically a rehash of what was said at the testimony last week when Powell testified in Congress, as well as 2 weeks back when he spoke at the press conference after the FOMC policy announcement. The economy is in a good position. If not for inflation risks from tariffs, we might be cutting rates already, but we are expecting, that is, the Fed is expecting to see higher readings for inflation over the summer because of those tariffs. And what the Fed wants to make sure is that we don't then have those inflation readings enter into inflation expectations and then become anchored, which of course would undermine all the progress that the Fed has already made in bringing inflation down. It is, after all, looking at the latest CPI data, just 2.4% at the headline, so less than 0.5% above its target. And the argument here is a familiar one, that with inflation that low and with the unemployment rate at 4.2%, which is historically low, or low by historical standards, not the lowest in history, certainly. We got as low as 3.4% when we were coming out of COVID, and there was a mass return to employment. Labor force participation obviously has evolved significantly, but nevertheless, historically, 4.2% is very low for U.S. unemployment. And so not surprisingly, what Powell is still saying here is there isn't a growth emergency, there isn't an inflation emergency. We have this weird thing with the tariffs that is something of a black box in terms of its impact. It doesn't make sense to jump out the window and make a decision when there isn't a flashing red sign somewhere in the economy compelling you to do it. So what they're going to do is sit on the sidelines, and that's despite the general consensus on the Fed clearly being that rate cuts are appropriate this year, and perhaps most interestingly, Powell saying that he can't say whether July is too soon to consider a cut, which basically means that every meeting is live at this point, though the markets are only pricing in about a 20% chance that the cut actually happens in July, and we'll take a look at that momentarily. On the data front, we have a slightly better than expected reading on the manufacturing side of June's ISM economic activity surveys. This is basically another version of PMI. The headline PMI numbers, of course, coming from S&P Global. That's sort of the biggest provider of PMI data for most of the world's countries. Some countries have more than one set of these numbers from different providers. China has that, and so does the US. The Institute of Supply Management is a very long-running survey on this and very closely watched. And what we see here is that the manufacturing sector remains in contraction mode here, as ever this is done in the logic of PMI. So 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So what you have here is a fourth consecutive month here below 50, and that suggests that whatever pop you had in manufacturing in January and February, that's this right here, where you crossed back over 50 into positive territory, ostensibly around the front running of tariffs, that is increasingly spent, and we're back into a contracting mode here. But it is the internals of this data that really grab attention and give the Fed chair some coverage in what he is saying, because what we have here, there's the 4 months of contraction here, readings sub 50 in the yellow bars. But when you look at the internals, the price component is surging. This is, in fact, the fastest price growth that we've seen in 3 years, going back to the middle of 2022. And it's happening at a time when that price growth isn't being motivated by economic activity in the sector, clearly, because not only is overall activity actually shrinking, but we can see here employment down. Fastest contraction in employment in 3 months. New orders down. Fastest contraction in new orders in some time. So what we're looking at here is an inflationary shock, not demand pull inflation. That is to say, more people want output, and so they compete on price and the price goes up. That is not what this is. This looks like the kind of stagflationary risk, or at least stagflationary dynamics, certainly not stagflation economy wide, but the kind of stagflation dynamics that the Fed is worried about. And indeed, we saw 2 weeks ago from their summary of economic projections, they're downgrading expectations for growth. They're increasing expectations for the unemployment rate. They're increasing expectations for inflation. And so that's exactly what this ISM data seems to imply. But of course, the big disparity continues to be what to do on rates. The Fed seems to think that we're going to have this kind of shock here where growth veers in a worse direction. Inflation veers in a higher direction, but ultimately things settle relatively in the longer run. And what this inflationary shock ends up meaning is that the Fed can cut less because they don't want to let inflation out of the bag as this washes through the economy and becomes what the Fed hopes will be a one-off, a transitory influence, as it were. And so what we have is a downgrade in rate cut expectations for 2026 and 2027, where before we were going to get 50 basis points this year and next. Now we're looking, and then a 25 basis point cut in 2027. Now the timeline is extended. We only get one cut next year and one cut in 2027. That, of course, is not at all endorsed by the markets. So here's 50 basis points right here. The markets, for the most part, are where the Fed is there. They have 58 basis points for this year. So they're only a bit over where the Fed is. And indeed, if you look at the disparity here, there is about a 32% chance, 8 basis points out of 25, that you're going to get a third cut. But 32% is not nothing. But it does suggest that the Fed is broadly in line with markets, at least for this year. For next year, though, it's a completely different story. The market has 68 basis points on the menu. That is to say, it's fully baked in 50 basis points in cuts. So that would give you the full 2 cuts there. And in setting it at 68 basis points, it suggests that we are a very good way to getting now to 3 cuts next year. So 68 basis points is 18 on the way to a third 25 basis point cut. So the probability of that third cut next year relatively elevated now at 72%. Now, if the Fed is saying 1 cut next year and the market is saying 2 and a 72% chance of a third, that's an entirely different kind of perception on what is likely to happen. Indeed, if we take a look at even this year's trajectory, we can see that since the Fed basically made the case for all of this with June's policy announcement and issued that summary of economic projections that we just saw, since then, the path even for this year has become more dovish, even as the Fed has said all of the same things. We can see the curve here has actually edged down. Now, that gives us the first rate cut in September, second cut somewhere here in October, December, with a fairly decent shot, even at a third by December. But as we saw here, the trajectory is still favorable of 2. So what is it that the markets are seeing here? Why are they so much more dovish than what the Fed is saying, even as the Fed keeps saying the same things over and over and over again? And we get back to this idea that from the market's perspective, the Fed is wrong to be worried about inflation risk. When we look at what this begins looking like at the beginning of the year, here's the S&P 500 in the yellow. It is falling alongside the bond market's measure of expected inflation. These break-even rates are the difference between nominal and real interest rates, so nominal yields and TIPS yields, that extracts the inflation adjustment that it would take you to get from nominal to real. Obviously, nominal rates minus expected inflation is what gives you TIPS yields. So if you take the difference between nominal and TIPS interest rates, the magnitude of that inflation adjustment is what you're left with. So you can see that these inflation expectations in the bond market were falling with stocks from about mid-February and until the beginning of April, around the idea that the tariff rollout as it was happening would be negative for economic growth. And of course, when you have that kind of influence, as positive economic growth would boost inflation through demand pull dynamics, here you'd have demand destruction, and so lower inflation, less upside pressure from demand on prices, which is exactly what you see here. Then, of course, we get the Liberation Day back and forth, and clearly sentiment recovers here. The S&P 500 is back to where it was pretty much at the start of the year, but inflation expectations have not followed. In fact, the nearer term 5-year here is basically where it was at April's lows. And so the market is saying here, the bond market, we have a growth scare that hasn't gone anywhere, still very much on the books. Just because stocks have rebounded doesn't mean that it's anything different here in terms of growth dynamics, which is why ostensibly they want all of this easing. Because while the Fed is worried about the tariff risk, the market obviously is not. And it's saying the Fed needs to cut to underpin growth. To that end, we can see here the Atlanta Fed's GDP growth now model. And never mind whether it's actually right about where second quarter GDP is headed, that's ultimately not important. We're far enough away from those numbers that this model is going to change quite significantly between now and then. More importantly, what this model is a distillation of incoming economic data as it appears. And by the way, the ISM numbers from earlier today are now in this model. So what we see here is the tone of the data going into the model since about mid-May has been clearly negative. And so the way the wind is blowing, as it were, for the U.S. economy is toward weakness. We see the same thing from the economic surprise index data that Citigroup puts out. We can see the U.S. is clearly the weaker hand here across the major economies. In the blue here, if you squint, is the global reading. It's been heading lower, and we can see that it's been heading lower because of what's going on in the G10 economies as emerging markets hold up here. And we also see that whatever's happening in these G10 economies isn't happening because of Europe, which we can see is holding pretty well here as well. So clearly, it is the U.S. that is now the main drag on the tone of global economic data. And this, of course, tells the same story. So what we find today, then, is a manufacturing survey that generally tells us the Fed is right to be worried about what is happening here with prices and with demand diverging in an adverse way. And so in that sense, what it's saying here makes sense. But also that the markets are looking through inflation and saying the impact on prices will ultimately register not as sequencing where first you get the prices, then you get the hit to growth. No, the markets are going to be focused on the growth, which is already coming undone. And that beckons rate cuts because inflation is going to get pushed lower by the demand destruction of an economic downturn. And how this gets resolved and which way it gets resolved ought to be very impactful. The dollar, of course, has been falling with this deterioration in the Fed policy outlook, and stocks seem like this rise was built primarily on sentiment, but certainly not invulnerable to growth concerns when they become acute. And so with that in mind, there is perhaps a vulnerability for stocks to come in and for the dollar to rebound if this starts to shift this way or that. With that, we're going to be watching out for the next layer of this ISM data that's coming later in the week for the all-important service sector. And then, of course, the U.S. jobs report as well, which we're going to focus on in depth tomorrow when Macro Money returns, as it always does, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close. In just 30 minutes' time, I'll be on, as I am every Tuesday, with Victor Jones for The Price of Truth, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Happy trading. Macro Money will be back.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
Oh, yeah. Tasty Nation, good morning.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Your crypto needs a wallet, and crypto is better when it's tasty. You can now do more with your digital currencies with the Tasty Crypto app. We're proud to offer a self-custody wallet for Bitcoin, Ethereum, and Polygon. Transfer your digital tokens directly in-app and access thousands of tokens available only on-chain. Your wallet is your key to decentralized finance. Download the Tasty Crypto app and get started today.
The beauty of Thinkorswim was that we were different. From the name to the front-end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Got trader's block? We've got the cure. Get data-driven trade ideas with Cherry Picks, our weekly newsletter that gives you insights into the market. Sign up at tastylive.com/newsletters.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
If you missed the live show, here's our cherry on top weekly recap.
Question for you guys.
Yes.
Vanetta this morning was giving me a little
flack. It was lighthearted. She meant well.
Okay.
For my particular baby face.
Yes. You are young.
Just
young
question for you guys, because I look up to you both. How much of your success, I don't know, financially with the ladies, do you attribute to having facial hair? Is it something I should work on actively?
Ooh. See, the thing, I can hear John laughing out there. See, the thing is that, you either have it or you don't have it. And
All right.
You just don't.
I could put together a pretty gnarly neck beard.
It's a manly thing.
The last time I shaved my face, it was to dress up as Sting for Halloween. Like Sting the wrestler.
Every time I leave Tasty, I miss it. Even like when I go home after work, I think about Tasty. I'm like, I wish I was really in the office.
No, you don't.
I don't.
You just went abroad. Were you able to just fully disconnect?
Fully.
Yeah.
We saw several artisans.
That never ends well. Like in movies, that happens. The guy's like,
Get the full scoop by checking out the archives at tastylive.com.
What is going on, everybody, and welcome back to Risk and Reward. Today, we have a little bit of a different of a segment. We're going to dip our toes a little bit into some tasty effects. So today we have Glenn here. Glenn, great to be with you here, brother. And Gus, what's going on, guys? How we doing today?
Pretty good. Thanks for having me, guys. I'm excited.
Yeah, we're
first appearance on Risk and Reward here.
Yeah, it's exciting. We're happy to have you. Happy to learn a little bit of Forex here. Happy to learn. I'm excited to learn what a pip is. This is a whole new word to me. I have no shortage of questions, but yeah, we're very excited to have Glenn in here today. Grumpy Mike, you got a little tag going on here on YouTube. Congrats to you, brother. I don't know what that's for, but you deserve it.
There we go.
Number one. I have no.
Yeah,
clue.
no. I mean, I'm excited about the Forex stuff for today. I know pips. That's what comes to mind right off the bat. I know pips was going around as a topic a few years ago, so really glad to get into it today and kind of pick your brains a little bit. So before we get into that, I mean, how are we doing, guys? All-time highs? Do we have any opinions on trading all-time highs? Glenn, I'm glad we finally get a talk on the show together. How do you feel about all-time highs?
I mean, it's a good thing all around, but it's interesting going into it on a holiday week, The backdrop is not what I would have expected for an economic picture of all-time highs, but we're back. Tariffs who? Who even remembers April? All I remember is I got in. Let's go.
Exactly. I know. Gus and I were talking about how every week it's like things come and go so quickly, trends, market news, whatever the case is, but it feels like we're talking about something new each week, and it feels like we're talking about inflation, tariffs. Time's just flying. It's like a new topic every single week. But Gus, anything kind of standing out to you getting into this week before we get into our Forex?
Well, I mean, SPY is going to go to 700, so I think that's probably
SPY 700.
That's
you
probably
heard it here
the
first.
The first trade that I'm going to put on is I'll take some SPY 700 calls, probably just weekly.
Okay, I like it.
I think we're going to get there pretty quick.
I was going to say, even on the short week, let's just call it Thursday.
Yeah. I guess short week. Maybe it'll take until next Friday to get us to 700. But nothing else jumping off the page at me too much today. I did tail the cherry picks. I got some ETHA here. I usually don't try to play too much with these crypto ETFs. I've said before I'll just trade the crypto, but being able to get the options exposure, the defined risk is a very nice aspect of them. So jumped in on that. And otherwise, everything's kind of been printing for me, honestly. Today was insane. Today was one of the better days I've had in my career. Everything went the right direction. And it was funny that it happened that way because it wasn't even like we had some cataclysmic market-wide day, but everything I needed to moved. And shout out Bath and Body Works. Let's take a look at this one real quick before we jump into
that was not on my bingo card.
Oh,
today.
Look at
all-time highs. Let's look at Bath and Body Works.
It's jumping off the page. I've been shouting Bath and Body Works from the rooftop since the beginning of June. So
they're in the
this was a good
80, right?
What's up?
They're in the Magnificent 80.
Oh yeah, I do believe that they're going to be the next addition to the Mag 7. We're waiting. It's actually going to be a substitution, not an addition. They deserve to replace Meta or somebody. I don't know. But yeah, going well. Still long delta, and as I've said before, I think this is really reminiscent of the COVID recovery, and I think that we could go very much higher.
Yeah, I mean, this, correct me if I'm wrong, Errol, but this is, in my mind, at all-time highs is where it really tests you as an active trader because, maybe a couple months ago, you were all buying the dip, and even on the ride a month ago.
Not enough.
It's still, hindsight. But now it's kind of like, are more people just scared to get in now, keeping cash on the side? How do you stay active and engaged? What do you think?
Yeah, I think it's one of those things where we had the dip, we had the opportunity to take a little bit more advantage of volatility. I mean, I tried to do that. I wish I would have gotten a little bit more long delta, but I mean, I got to sell some long premium whenever we did have that dip in early April. So, I mean, I feel like it's one of those hindsight things now. It's more so, okay, I know how I'm going to better prepare whenever we get a little bit more of a significant dip, because it feels like volatility dried up a little bit once we've been taking out those all-time highs. So, I mean, I'm glad I got to sell some premium, but all-time highs more so sitting on the sidelines from my point of view.
Yeah, it's an interesting spot. All-time highs bring all-time resistance. That's something we throw around often on the show here. But you know, when you break through the resistance levels, things tend to pop. So I think there could potentially be a lot more upside left in this run. It's just about, you know, and it is. I think that's a great point, Glenn. It tests your ability to be an active trader. You're sitting here at this time where if we go higher, we are likely going to go much higher, at least on a day-to-day basis. But also, it's this firm resistance. We could easily bounce off and breathe a little bit before we move back up. So yeah, I think it's a test of management and you know, managing positions through the times of turmoil should they come, because at least in my opinion, you just got to stay long until you can't, and then
you're prepared for it. I mean, I'd see that VIX position. You're prepared.
Hell
for
yeah,
it
you see that VIX position. Just in case. Just freshened up the VIX position today.
Yeah, don't brush that under the rug. You didn't bring it up, but I seen that.
I was carrying. I was holding that 17.
Everything's fine.
Everything's fine.
The VIX worried about. This is my one hedge against the rest of this portfolio, man. No, the VIX though. I did update this position today just to act as a hedge. I was carrying a August 15th 17 call forever. I have essentially rolled that into an October 22nd 15 call. So should we ever get that pop to 40 in the VIX, that will hopefully be enough to offset everything else that will be burning in my portfolio, but probably not. We'll see.
No, I love it. I know one that worked out really well for me today was Lulu. I know we got a little bit more of a pop in Lulu. I was double dipping. I know after earnings, we had a nice run to the upside on Lulu. We had sold back off, sold another out of the money put spread on Lulu. So we're getting some volatility from names that I wouldn't have expected. I'd be talking about most today. So nice to sell some premium across the board, and something might surprise you. So that's where I'm at.
It's true. It's true. I wrote an article about your favorite stock, Disney, today, Errol.
I know. I peeped that. I like that. I mean, Disney's been top of the headlines all week. So
it has. Anyway, that's enough about regular company. We could talk regular companies anytime. Let's kick it over to Glenn. Glenn, teach us some Forex. Teach me how to trade Forex.
Absolutely. So as you know, now tastyfx is fully integrated in the Tasty Trade platform. So that gives you access if you open a tastyfx account using your Tasty Trade credentials. You can now access over 80 spot FX currency pairs. And those are all traded on leverage. It's a wonderful diversifier to your portfolio. Not a lot of similar products offered previously from Tasty Trade, but it does come with a whole new learning curve. So I have a couple slides if we want to bang through those. You guys are all quick learners. So this is all you need to know about FX from a basic perspective. Nothing scary. If anything, there's less terminology than options. Not a lot of Greeks. I don't even know if PIP is Greek. Maybe it is. Doesn't sound as Greek. But yeah, we'll just bang through these and then get into the platform, answer any questions you guys have. So first, jumping in the first slide, what is Forex trading? It's an important question. I'm sure everyone has some level of familiarity with it. It basically is just the process of exchanging two currencies, one for another, and the rate at which that is exchanged. And what you may not think about all the time is that that moves constantly because this is a global marketplace. It's not one exchange like currency futures offered through the CME. This is a global marketplace. And so what I find really interesting about this is there's a ton of price discovery. So there's a whole interbank market. You've got corporations that are hedging currency risk all the time on a monthly, quarterly, yearly basis, companies that are engaged in global affairs. You have central banks themselves readjusting their balance sheets and their currency exposures. And then you have everyday tourists like you or me. I'm going to Amsterdam later this month, and right now I will not be able to buy as much as I would have at the start of the year, given the over 10% move in the euro dollar exchange rate. So that's kind of the backdrop of all Forex trading is that global currency marketplace. And when you're reading these currency pairs in the platform, you'll see that each currency, it's not like stocks where you have names of 1 through 4 characters. Each one is 3-letter codes, 2 of which will be the region or country, and then the last one just the currency name itself. So here we're looking at Great British Pound versus the US dollar. So that's really it from that one. If we move on to the next slide, and then we'll stop for some questions. Just how to read these currency pairs in a practical way. You're going to be looking at the first currency to determine what you're actually doing when you're in the platform, what action you're performing. So buying GBP USD would mean you're going long British pound and selling the US dollar simultaneously. So these pairs are all quoted in pairs. So here you're simultaneously always buying something and selling something, and you're looking to that base currency, the first in the pair, to denote what you're actually doing. So selling the British pound US dollar pair would mean you're bullish on US dollar against the British pound. So you're expecting that rate, if you're looking at a chart, you're expecting that rate to go down, but that would mean the US dollar strengthening. So two-sided, for most of these markets, there's only one pair. There's some synthetic alternatives where you could have like a euro pound and a pound euro. But for most of the dollar pairs, you'll only see it one way or another. And that's just because of the historic exchange rate and how these were set up. And so in this currency pair, you'll see US dollar as the quote currency. But for something like a dollar yen, that's quoted in yen. So
interesting.
A lot.
So if we were looking at this GBP USD right now, the dollar's worth a little bit less than the pound. So that would be something like 0.9 would be.
You're actually looking at the British pound is actually stronger than the US dollar. So 1 British pound would equal the exchange rate you're seeing in dollars in the platform. So that right now is 1.37.
I see.
So it costs $1.37 to purchase 1 British pound.
Okay. So this is pounds expressed as US dollars.
Correct.
This way is the way to think about it.
Yep.
Okay.
And so the technical terms are the base currency and the quote currency, but you can read into that as much as you'd like. There are some implications, some nuanced implications as to, when you're determining your position size, that'll actually be based on your base currency. So for this pair, if you enter in whatever lot size, whatever position size, you're selecting how much British pound exposure you'd like denoted or quoted in US dollars.
I see. And so then in that circumstance, say we go long this trade, that means that I'm betting on the pound to go up.
Correct.
Okay.
You're bullish on the British pound as it relates to the US dollar. So you're betting that the British pound will strengthen against the dollar. And what's really cool about the granularity of these markets is you have access to 80 plus currency pairs. And so if you think the British pound will strengthen, but not against the dollar's in trouble, then you can speculate on the euro pound, the pound yen. You can get a lot of second tier diversification that doesn't have to involve US dollar, because all of our accounts here in the US are primarily exposed to US dollar, right? Because you have Bath and Body Works US dollar pair and Lulu dollar pair.
Are there any pairs, depending on their volatility, that you find yourself to gravitate towards?
Yeah, so it's an interesting dynamic because the margin requirements are set by currency pair. And I think if we want to skip over a couple slides, Yeah. So here we're looking at the minimum margin requirement. And so these differ by currency pair, and it's actually set by the regulators here in the US. And so it's a fine balance of what currency pairs tend to move the most versus what the margin requirements are, because I don't know about you guys, but if you want to lever up, then it definitely factors into the equation. So, I mean, we see Australian dollar against the US dollar move. New Zealand dollar versus the US dollar is actually a very similar exposure to Australian dollar because they're so correlated, but that New Zealand dollar tends to be slightly more volatile. So there, if you have that thesis, you're getting the same margin requirement. You're actually getting, you're getting a cheaper, the US dollar is stronger against the New Zealand dollar than it is the Australian dollar. So even that factors into what kind of position size you can put on. So that would be a more volatile play than traditionally the British pound. You're margined at 5%, and so hard to capitalize on big swings. But yeah, I mean, currency markets this year have been wild and irregular, so a lot more volatility this year than perhaps in years past.
Well, interesting. Well, let's hop back one. I'm anxious to learn about what a pip is.
All right, let's go back one slide.
This is such a fun finance
to
word.
what
I'm
our
excited to add it
pips
to my vernacular.
Yeah, no, pips are a great term. They stand for percentage in point, and it's basically just the minimum tick value for these currency pairs. So because the nature of how these currencies are able to be offered on leverage is because the exchange rate doesn't fluctuate a ton historically. It's not like they're changing cents at a time. So the minimum tick value and what a pip is often quoted to the fourth decimal place in a bunch of major pairs, US dollar pairs. So here we're looking at this sell and buy price. The pip value here, they're quoted to the 10th of a pip. And you're seeing the spread in the middle is 8/10 of a pip. So it's not the most important thing, but what you do get, an important context for actually trading these markets, is when you put in your position size, the platform will show you what your movement per pip is. So if I looked at standard deviations earlier this week for what kind of a daily range is to expect from some of these dollar pairs. And so for a euro dollar market, that might be 60 pip move in a day. And so then depending on your position size, you can look at this and say, okay, if this position size will move $1 per pip, then I can start to kind of backtrack what my profit targets are, how much of my margin I'm actually willing to risk on this position, where I could maybe set a stop loss. So that's the only real thing you need to know for pips, is that it's the fourth decimal place for everything except yen pairs. Those you'll see because the yen is so undervalued nominally. You'll see an exchange rate of the US dollar Japanese yen is 143.00, and so only the second decimal place in those pairs is 1 pip.
Interesting. Okay. So that's why you are then allowed to take this much leverage. This isn't like some Binance 50x Bitcoin situation. It's simply because the volatility is so low that is what you must do to actually make any substantial amount of money.
Exactly. And if you ask our good friend Chris Vecchio or Ilya Spivak, they'll tell you that they used to trade euro-dollar markets that were offered 100 to 1 or even 200 to 1. That's been reeled back as regulation has increased in these markets.
Communist.
But yeah, you're still your max leverage in these currency pairs is 50 to 1 offered on euro dollar and US dollar Canadian dollar, and by whatever math term, by proxy, the euro Canadian dollar pair as well.
Interesting.
Yeah, as much as we say it's set by currency pair, I think technically it's set by currency. And so whatever the most restrictive currency in the pair, that's what the minimum margin requirement is.
That's interesting. Well, yeah, that's good information because the leverage. I was a bit scared of the leverage.
Exactly.
Yeah, I didn't know what was going on over there. I didn't know how those numbers were even a thing or possible. But 100 to 1 wasn't a rare thing to not hear about either.
I know. Yeah. So I think it saved more than a few people's accounts to reel in that leverage, but you're still getting 50 to 1 on major currency pairs. So I think that's if we go to the next slide.
Yeah, there's one.
This isn't too bad so far.
Yeah.
This isn't too bad.
I'm following all this.
FX not too bad so far. Yeah.
Yeah, and so the main thing, the main last thing I want to hit on for kind of these product details is the easiest comparison is, or parallel to draw, is to currency futures, right? And so the main differentiator here is flexible sizing. Here, position sizes start with just 1,000 units of the base currency. So that would be for that Australian dollar, US dollar pair. That's only about $20 in margin, and you can scale up in those increments. So a lot easier for small accounts or even medium accounts to layer in to positions to that granular of an increment. And then the other piece is TastyFX is able to offer 0 commissions on every FX pair, just given how they're compensated through their hedging agreement. They're not, you're not trading with, the whole interbank market. TastyFX is your counterparty, so you're trading with them, and they're able to offer tight spreads, but spread your only cost to get into some of these markets. So, yeah, I mean, if you have $1 per pip of movement and you have a spread of 0.8 pips, that's less than $1 you have to make up in price action to essentially cover that cost, the deviation from the true bid and ask spread or the mid price. Yeah, so that's a lot of the basics. So a quick comparison to currency futures. Let's go to the last slide. It might just be, so let's get into the platform now.
Hell yeah. I'm ready.
And we'll talk through, in the short time we have, just looking at these markets. So
Euro USD.
There you go.
Did it choose for us?
Perhaps.
That's the default when you open it up.
And so the default, here we're in the desktop platform. You'll see a TastyFX tab on the left-hand side, and that'll take you, if you don't have a TastyFX account already, you can click in from there. It'll shoot you over to the web platform to open up an account. It's quick, just a couple questions uses your existing TastyTrade data, asks you a couple more questions. You should get straight through. You'll get to this screen, to this watch list. And what we've done for everyone, but particularly new Forex traders, is we've made this watch list as easy as possible. So we offer 80 plus currency pairs, right? I think it's 86. But you don't really have to go far unless you're really looking for trouble, looking for something. And so that popular US dollar bucket there at the top of those 7 currencies, those are the most liquid markets offered, most liquid markets in the world, most traded markets in the world. And so you don't have to go much farther, because if you want non-US dollar exposure, then the popular non-USD right below it are the most liquid markets that don't involve the dollar. And then it drops off pretty quickly in terms of exotic pairs and emerging currencies. So a popular one I've walked through with Jenny and with our good friend Nick Batista is the US dollar Israeli shekel, which is topical given the recent conflict in that part of the world. But there's no real need, unless you're really looking for some Danish krona exposure or anything, to start this far down the watch list. You've got the whole world by proxy available to you from those popular US dollar pairs.
Alrighty, well let's put a trade on, man. What should we do? I want to get contrarian. I want to get long the dollar.
All right, so yeah, you're looking at an impressive backdrop for this historic dollar weakness. I'll walk you through just some of the extremes. We've got euro dollar hit 118 for the first time since 2021 today. It's still hovering around there. It's off from its highs from this morning, but it's still around that price handle.
It's right there.
Yeah, and then you've got British pound, US dollar, highly correlated to the euro dollar. That I think is an extreme back to 2022. But if you're looking for historic extremes, look no further than USD CHF, which is the Swiss franc. That one, if you go to the trade window, there you'll get tastyfx charts. And here we've seen yesterday and today the only daily closes below 0.8000 since 2011. So this is, in terms of historic extremes.
Sounds like what we call in options a dip.
Yeah, if you called it a dip not even a week ago, you're hurting a lot more. I mean, I thought that 81 price level was pretty extreme. That was extremes dating back a decade as well. So this has been very unrelenting since Swiss franc is typically a safe haven currency. And so we saw a bid to the franc during all of that geopolitical conflict, but we've seen no reprieve since as the Europe region, European currencies have continued to outperform the US dollar, as perhaps there's sort of a recentering of a lot of world assets, and defense spending. Is Europe going to have to defend itself? Is the U.S. pulling out of trade deals? All of these pieces. It's a lot of macro factors that go into this. A lot of uncertainty in the dollar thus far around our spending. Are we going to cut rates? Will there be a new Fed chair? Not a lot of confidence in the U.S. dollar so far, but FX markets historically mean reverting. And so if you have that contrarian stance, then you can pop over to the trade ticket there. The minimum trade size is 0.01. And then if you click out of that, you can select your buy or sell above it.
Where at? I see.
One of the prices.
I see.
Yeah.
I see.
Yeah.
Okay.
And so this typically, Forex markets are traded 24/5. This is typically the least liquid time, because when you think about the major players, US is out, Asia hasn't come in yet. So in terms of liquidity, this is not the most optimal time, but they're still open. You're still able to put in trades just with a wider spread. And so then it'll note your francs per pip. So you've got, at this micro lot size, you've got, your position will move 0.1 francs per pip. It'll show you your margin, so just $30 of margin, what that is in Swiss francs, and your resulting position. So you're controlling, with this position, almost 800 Swiss francs, which is, I'm not good at quick math, like a 1,000. Oh, duh.
Oh, yeah.
Because
I was going to say, are we not looking at it?
Yeah, because you're absolutely right. What this position size tells you is you're controlling $1,000 US. So there you go. That's all you need to know for that trade ticket. If that's the trade.
Yeah, we're definitely going to be locking into more of the news than we already are with all of these. Deal confirmed. More geopolitical events to pay attention to with some FX now. Glenn, thanks for hopping on here, breaking us down some of this tasty FX for us. Glad to have you on here. Anything else, Gus, before we hop out of here today?
Yeah, no, nothing else. We'd like to have you back on sometime soon.
Thanks for letting me talk so much. Sorry to squeeze it all in, but excited to come back anytime.
No, looking forward to it. That's going to wrap it up today for Risk and Reward. Be sure to stay tuned for more segments coming on next. Glenn, we appreciate having you here. That's going to do it for Gus and Neat, and we'll catch you guys next time. Peace.
Look who's back testing. tastytrade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at tastytrade.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top yearly recap.
Breaking news on Instagram. The first segment of your line dancing has been posted. Left together, switch, turn. Right together, twirl, turn. Hip, hip, hip.
Right together, spin, clap. Left together, spin, clap. Hitch, 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 turn, shuffle, rock, shuffle, rock, shimmy, shimmy.
I took 5 lessons for Casey's wedding, and all I knew how to do was
Right together, spin it around. Yup. And you want to clap. And then like strut down, strut down, strut down, strut down. Right together, spin. Left together, spin. Hitch, 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 cross, turn, shuffle, lead, shuffle, rock, shimmy, lasso.
this is not good.
Hey! Oh, he's got the walk down. He's got it down.
Perfect, and you got the band. You got everything.
That is not even close.
Drop, bitch, stole my. Oh, it's flawless.
Look, it's beautiful.
Flawless.
No.
You're walking way too fast.
And go stick your finger in all of our lunches.
Now complain about something.
Oh, God. You watched the debate, you knew who won, and you just didn't want to admit it.
I was in New York. I was flying home that night, and I'm so sorry that I didn't go back and tape the vice presidential debate.
First of all, I think it's hilarious that you run a technology company and you still think you think you had to tape it in order to watch it. You think you have to tape it?
He didn't have a blank VHS tape to spare for the debate. Stas, what comes up next? The opening bell. Don't look so surprised. Sadlov has been this way since 1980 when you first started trading. Wait a minute, was it always 8:30? Yes, the opening always was the same. The closing has changed.
Like, what has
Wasn't
changed?
it?
I don't think so. Nothing's changed. The only thing they did, I think, was add the 15 minutes.
Excuse me?
The only thing I ever think that changed was the 15-minute curb session.
From 3 to 3:15, so they did change it. So it was the closing and not the opening that's changed.
For option traders, the 15 minutes.
Well, listen. We're not bean traders here.
Do not engage.
When I got,
we didn't, wait a minute. So
when I got in this business,
we used to open it at 9 o'clock. Since 1980 to now, we didn't always open at 8:30 in the morning.
Yes, we did. Is that a $20?
I am going to get this $20 off of you.
I don't think so.
No matter what. Chris, how are you, my friend? Chris, your job after you get off the show here is to find out when the New York Stock Exchange opened in the 1980s, what time they rang the bell. I have a $20 bet with Sosnoff. We're going to be eating good tonight. I already decided that Sosnoff will be having cereal for dinner tonight. Very much. Thank you very, very much.
Not 1980.
I remember. I was on the floor. I was working because I would have to get up earlier in the morning.
In 1980, the New York Stock Exchange opened up at 10 a.m. Eastern. It closed at 3:30 p.m. Eastern Time. The schedule was in place until September 1985, when the opening time was changed to 9:30 a.m. Eastern.
Pay me,
Get the full scoop by checking out the archives at tastylive.com.
Oh, yeah, it is Tuesday, July 1st. First day of the new month. A little bit after 5 p.m. Central Time. The best time, you know what that means. It's time for Tasty Live's Evening Show. A little podcast, little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world. And I don't know, man. Every day that goes on, it feels a little bit more like we live in either some sort of simulation or a soap opera, and I cannot tell which one it is, but we've got the big brain with us on this lovely Tuesday evening to help us try to figure out which one of those two things is true. I'm talking about the one, the only, the incomparable, the big brain, the global head of macro here at Tasty Live, talking, of course, none other than Ilya Spivak. Ilya, how you doing, my friend?
Much like you, it seems, because we were just talking here before the start of the show that the headlines are coming so fast and furious that it's tough to keep up, probably for all of us and probably for the markets, because it's basically a goose egg on the S&P 500 for today, and not a whole lot has moved around, although there were some interesting things today. And I'm pretty much in the same boat. I'm looking at all this and going, well, there was a lot that happened today, but was there? Because the basic conflict at the heart of what we're looking at here is exactly the same.
I agree to an extent. There's a soap opera thing that's happening right now that's really not applicable to much of the overall macro dynamics of price. It's probably directly related to Tesla being down 5%. So there's like that whole thing going on. I would agree with you that at the top line level, the S&P 500 being down 11 basis points, you would think, oh, it was a pretty boring day in the market. But I would also say we could unpack this and we can go, for the very first time in a long while, you've got a breakout again in the Russell, with it being up 1%, and the NASDAQ being down 1%. So you had sort of this unpinning of what had been this sort of buy tech, sell everything else, a day that sort of looked like we got past the end of the quarter, and then people go, okay, that's enough of chasing that performance. Let's figure out what might be cheap on the board. And that's not just like at the index level for Russell and NASDAQ that happened, but that happened like even though like the S&P was down 11%, man, or 11 basis points, there was a lot of stuff that like rocketed higher today. We'll talk about that in just a minute, but I want to get messy. Give me your messy. What the hell's going on between Elon and Donald Trump? Like, what's your quick elevator, 30-second, quick and dirty? What's your take on their back and forth?
Well, there were those of us that looked at how Elon Musk suddenly found political religion and threw himself into the fray, having been mostly on the outside, mostly kind of opining, but not so hands-on. And frankly, on the other side, where he was active. But in recent years, he became very loud and very active, and of course became very involved with the Trump campaign and helped him quite a bit. I mean, obviously the two sides now sniping at each other will say he helped a lot or a little, and I think he's probably overstating that without him, the president wouldn't have been reelected. The president is probably underplaying how much Elon helped. But obviously we've come to some kind of an impasse. And I think actually the way that you see the markets react today kind of starts to tell you why Elon is so upset. And it's really about this bill. This bill adds about $3 trillion to the deficit, give or take, over 10 years, which is about the same as what Biden added to the deficit. Just
close to, I think it's close to $4 trillion when you add in interest. So you're right. It's $3 trillion just on their spending and on the tax cuts. But when you add in interest over a decade, it's closer to 4. But yeah, you're right.
Right. I'm leaving the interest aside because obviously that's the other thing that we're going to talk about here, because the president sniping at the Fed and all of that is sort of the other side of
that's the days of our lives part 2. Part 2.
Yeah, in Wu-Tang terminology, that's a different chamber. And so when you look at all of this, you go, okay, so let's just take this at face value. It's about, give or take, a $3 trillion-ish increase in the deficit, which obviously flies directly in the face of what Doge was trying to achieve. But even more callously, that NASDAQ is down and Russell is up, mostly thanks to real estate and financials. In the wake of the passing of this thing through the Senate, kind of tells you where the policy priorities in this thing are. And they're not tech favorable generally. As far as Elon Musk is concerned, because it takes away his EV mandate. So if you're Elon Musk, you go, okay, well, I was given the job of reducing the deficit. I believe that passionately as a policy objective. This does not that. And on top of it, you're taking away the EV mandate that I've enjoyed. Now, you and I think, are of a mind that the EV mandate is actually not a bad thing for Tesla, that it's going away, because in a sense it locks in their first mover advantage and protects upstarts, sort of keeps upstarts out of its pool to some extent. So maybe this is not a thing to be that mad about from a kind of practical perspective, but it certainly seems to be that this bill has been a major kind of rupture between these two. I'm just not sure that it means anything in practical terms at a macro level, because the thing looks like it's pretty much a done deal. And if you're operating in a 45 in, 21 day out type of sort of typical tasty cycle, even if you're any kind of hands-on, let's say, trader rather than longer term asset allocator, this shouldn't really change the weather for you, because whatever this thing is going to do in sort of its mass is going to be spread out over a long period of time. And whether you're looking at what it's going to do for Tesla specifically, as a trader, are you going to be a seller of Tesla on this? Probably not. As a longer term holder, does this change your story? Probably not. So I think the most actionable takeaway from all of this, because this is really about the bill and this is what they're arguing about, is the SALT deductions, the state and local tax deductions, because which
went from a $10,000 cap up to a $40,000 cap in the past version of the Senate bill, which now, by the way, I'm sure everyone is aware, but just in case you're not, this goes back. This is a new version of this bill. So this Senate bill goes back to the House and has to get passed on the House again.
Right. And so that's probably the most immediate thing from a kind of macro perspective, because you figure, okay, next year that's more money in people's hands in sort of high tax states. And so maybe that gives you some kind of a bid up to consumer demand, and maybe that gives you some kind of bid up to inflation as well next year, sort of perhaps, but it's not relevant for obviously the immediate consumption and growth dynamics. But that's probably the most sort of the closest I think that this has any kind of implication for anything near term, is it might echo into next year's Fed policy expectations. But looking at it, the markets aren't seemingly terribly concerned. So
you know what I thought? This is what I thought when I saw this back and forth. I go, Tesla's numbers must be terrible. Tesla's delivery numbers that come out on Wednesday, they must be they must be terrible. And Elon knows they're way off. Like Tesla's price is way off. So he picks a fight with the president. He de-risks his stock 5%. And then his delivery numbers on Wednesday are not going to look like they crater the stock down 10%. it's going to look like
That's
picked a fight with
he
picked a fight with the president, and that's why their stock is down. Not that their delivery numbers, which are already expected to be horrible, were even worse than expected. That's what I thought when I saw this.
Maybe.
I'm like,
maybe he did this whole walk back. I mean, obviously their rupture seems to be like this bill seemed to really be the thing that broke the camel's back for them when they were initially getting into it a few weeks back. But Elon seemingly walked away from that conflict and he reignited it. So maybe he's stirring the pot again around these delivery numbers. It makes sense to me.
Well, let's have some fun here. So let's get away from the Elon messiness and let's get into brass tacks here, because I think sometimes the people can have Elon and Trump fatigue, and they're like, I don't care about these crazy people. Let's talk about how do I make money, stay alive, and stay sane throughout all this craziness. The S&P 500, by the way, down 11 basis points. Mentioned that before. The Nasdaq was down nearly 1%. The Dow Jones, sort of a low beta, sort of higher, blue chip, higher dividend paying stock, up nearly 1%. And the Russell, as I mentioned, was the outperformer on the day, up 1%. So there was this, we kept saying eventually there's you either have to do one of two things, man. You got to go correlations to one, everything takes a haircut, or you got to have the broadening out trade, because you just, the breadth in this rally is so disgustingly narrow. They're just buying like 5 stocks. And at some point, you got to make a decision. And I had mentioned earlier, I think that the difference in performance from the NASDAQ and the Russell's underperforms the NASDAQ, I think is at some historical record, the basis between these two in performance. And I think it just recently passed what we saw during the dot-com bubble. So you got this violent snapback. So let me just start here. Do you think, I don't know how much you keep your eye on the distance between the Russell and NASDAQ, or if you trade that relationship, but do you have an opinion, or would you bet on the continued uncoiling of the Russell versus the NASDAQ? Just to let everybody know, that's about a 2% difference. So if the NASDAQ's down 1%, the Russell's up, that's 200 basis points in difference of performance. The widest that normally is, on average, would be like a 50 basis point move. So a 200 basis point move is a really, really big deal. Do you think there's more room for that to run, Ilya?
No. And obviously that doesn't mean that it can't run tomorrow or it can't run the day after. I wouldn't put a pin in it and say after today it's done. Nobody knows that. But in my mind, what comes next and sort of the character of this market isn't the kind of a thing where you're going to say, okay, these sectors go over here and these sectors go over there. It's not a broadening that's coming. It's not a rotation that's coming. It is a correlation one type thing. And in my mind, it's biased lower. Shock of shocks, I know.
Okay. Actually, unpack your thought. There's still something to be said, though, that if we have correlation to one, that perhaps because the Russell's so beaten up, and the NASDAQ is so outperformed, that even to the downside on a relationship basis, if you're long one, short the other, you can still technically have underperformance, even if both are going down. So, but please finish your thought. Sorry.
Yes. No. So that's absolutely right. And that could happen, but I'm not prepared to bet on it.
Fair.
And I'll walk you through the logic.
Okay.
The idea that we're heading into some kind of an economic downturn, that the market isn't appreciating, at least in equities, that comes from the bond market and from Fed funds futures, sort of the market's view on rates and on inflation. In the bond market, the 5-year break even is basically back to where it was at the lows in April, which was the bottom for that after the sort of growth scare with the rollout of the tariffs from mid-Feb February through sort of that Liberation Day seesaw. Until we got that kind of dramatic crescendo where you get the Liberation Day tariffs, then the market goes, holy moly, the president walks it back, stocks rebound, break-even rates never do. And
You're
so
talking
they're
about 5-year break-even inflation rate or something else?
5-year break-even, yeah, which was falling since the beginning of the year. To tell you that the markets are less concerned about inflation, more concerned about disinflation.
Mm-hmm.
Well, while stocks rebounded from that April low, sort of famously at this point, break-even rates didn't. And now they're back basically to those April lows. So they're telling you the Fed's wrong to be worried about inflation. What the Fed should be worried about is growth. Then you look at Fed funds futures and you see that the markets are baking in 125 basis points in rate cuts between now and the end of next year. And lest you think that this is a White House favorable Fed chair, most of those cuts don't occur after May. They're fairly evenly spaced out. So Powell's term ends May of next year. If you thought, oh, well, now the president is going to nominate a Kevin Warsh or David Malpass or somebody like this, these are just some of the names out there. And this is going to be a malleable Fed chair that's going to do what the president wants, and that's to cut rates. And so there's a hump after May. No, there's not. So it's pretty well telegraphed here that the markets just think the Fed's wrong.
Mm-hmm.
That essentially, when the Fed is saying we're only going to cut rates by 25 basis points next year, the market is saying, sure, but no. You're going to cut like at least 50, maybe 75. In fact, they're erring on the side of 75 increasingly. It's 68 basis points now baked in for next year. That's about a 70% chance that you get that third cut. So forget what I think. The market is telling you that the risk is inflation lower, not higher. And that's a growth scare. And the Fed is going to be forced to cut, and it's going to be forced to cut more than it thinks. And in a growth scare, who's vulnerable? Well, the small caps that don't have much cash, like the larger companies in relative terms, and that are more cyclically sensitive, which is what makes up the Russell, they're going to be more vulnerable. We've seen that tech can sometimes be a little bit better supported in an economic downturn because their business model is not so cyclically sensitive all of the time. That was obviously the story of COVID most dramatically, but that's a very kind of aggressive example. We don't have to go that crazy. So maybe you don't get this Russell out performance. At the same time, you get the sense that the market is vulnerable to realizing that there is this economic downturn that the bonds are yelling about, that stocks apparently have not noticed or wanted to bake in, at least up to this point. It seemed like since April through most of the second quarter, it was our fears about the ungluing of the global financial architecture with sort of the forced extraction of U.S. Treasury bonds and the dollar from the financial system. That's not what all of this is. So we need to calm down. And it seemed to be a sentiment thing. But now with S&P, NASDAQ at the highs, the NASDAQ may be more vulnerable just on valuation grounds, to your point, than is the Russell. So it's tough to say which one of these is going to outperform. I see arguments both ways. I would rather be short the NASDAQ if I'm going to be short something, because it is kind of headier in terms of where it is. But I'm expecting a general sell-off in stocks, and I don't really want to pick between these two indexes where I'm long one. I would just rather short the one that looks crazier and leave the other one alone.
I agree with everything you said. I think the bond market is telling a different story. I think clearly the U.S. economy is decelerating on paper. We're in the part of the cycle where we're now going to show what I believe has been reality, and now it's finally going to show up in the delayed data that gets put in front of everybody. I sort of still believe there's a real question mark on how do you discount the future in the next 9 to 12 months, given this big monstrosity of $4 trillion spending is going to work its way through. It seems like it's going to work its way through Congress and ultimately get passed one way or the other. With a few changes around the edges, but I don't think this is going to change much. So how do you throw that in the gumbo and then say, yes, we are seeing a decelerating growth. However, how exactly do I discount this monstrosity of spending from the fiscal government during this period of fiscal dominance that's going to be introduced? And I think that's a really hard calculus to do right now. I think in the absence of that, man, I'm in your camp. I'm waiting for a pretty fat left tail to pay. And I think that's probably decent odds. I think in the face of this big thing being worked through Congress, it keeps me a bit more honest and a bit more towards neutral, even though I do think that there are frothy parts of the market. And as I mentioned before, I think there are very few, less and less by the day, but there are a few aspects that are cheap. Home builders being one. Those finally got off the mat today in a really big way. We can talk about those in just a bit. But let's stay with bonds for a second. Bonds at 115.17.
Yeah.
Kind of a weird, interesting day for bonds. Little nasty little doji candle here. Your thoughts on just the long end of the curve? We've been slowly grinding higher up since that 119 low. We're at 115, which could be a little bit of a technical congestion area. Yeah. I still think that if we're at 115, why not 117? I still have an upside 117 target. I agree with long bond exposure. What do you think about bonds here?
I agree with you. I mean, obviously, we've been talking about this for weeks, and I've had the argument that the long end should rally. And there it is. It's just doing it in a way that bonds should do it. What we saw in April, he's slow and steady. The kind of crazy swings that we saw in the bonds in April are nothing that we ever want to see in long-term U.S. Treasuries. Jesus,
it's true.
Insane.
You don't want that, but for me, somebody who loves trading bonds, that was a gift. Giving me that much volatility in the bond market was a gift.
I enjoyed trading it. Yes, but it's not anything you'd expect to happen with any kind of regularity.
Yeah.
You look at the 30-year U.S. Treasury bond, it's supposed to move at a crippled snail's pace.
I'm not going to lie to you. I enjoyed the trading, but I was absolutely terrified to wake up every day. I'm like, what does this mean about, are we going towards Mad Max world any day now?
I'm saying, when you see the kind of swings that we saw in 30-year U.S. government debt, you go, oh, my God. It's on. Yes. It's Judgment Day.
Okay, so now here's the problem. Here's the conundrum. So what clearly, I think you would agree with this, Jerome Powell, if he cuts in September, bro, and the long end lifts again, he's cooked and we're all cooked, because that just signals to the market that the current set of tools that the Federal Reserve is trying to use to control monetary policy, they don't work. Do you get what I'm saying? Like if he's trying to cut short-term interest rates and the long end lifts again like it did last September, it's effectively rejecting the cut. And so you're trying to cut and lower interest rates, and if you end up getting the exact opposite where you lower interest rates and they go higher, which I think is a lower probability this time than it was last September. But I do think it's a live probability. And I think that's the last thing Jerome Powell wants, which is why he's trying to drive the bus as long as possible. And everyone's going, hey, you're supposed to turn. And he's trying to go as far as he can before he has to take the U-turn, because I think that's worst case scenario, where he lowers short-term interest rates and the long end rejects it again. Do you believe that that's true? That is sort of worst case scenario for the Fed, and they want to avoid that, which means they got to get as far as they can before they cut short-term interest rates to ensure that the long end will accept it.
I guess I don't see the narrative in those terms. I'm not saying that they're wrong.
Okay, well, react to mine. Just react to mine, and then put a new one on the table.
Sure. So I think there are a number of ways in which you could get the long end bond going higher, that is, yields going down at the long end. If the Fed,
I'm talking about the opposite. So yields. I'm saying if they cut interest rates in the short end,
yields will
and
go
long
up.
end yields. If long end yields go higher, that is a big problem for Jerome Powell.
I see what you're saying.
Because that signals again that for the second year that the long end is rejecting the cut. And even though you're lowering interest rates, long end borrowing, which likely is going to reflect mortgage rates and everything else, they're actually going higher. And financial conditions in the real world economy are getting worse, not better. And it sort of signals that his monetary policy is sort of ineffective to help in the real world economy, only the financial economy.
I wouldn't read it that way. And
you don't think that's a fear of the Federal Reserve right now?
I think it's one concern, but I wouldn't read the price action to necessarily conclude that that's the only possible explanation. The market very clearly was, so let's kind of take this step by step. Last year, there was a growth scare over the summer. And the market was yelling at the Fed, which was resisting rate cuts last year. And the market was yelling at them from about mid-April through the middle of September, going, you're going to miss the boat. You need to cut. And you saw this sell-off in the dollar. You saw a rally in the bonds. And it ran from mid-April until mid-September, when the Fed finally pulled the trigger. But when the Fed finally pulled the trigger, it did a lot. It did 50 basis points up front, which the markets didn't expect. It did 100 basis points that year, which it all announced in one go, basically, in September. Because it said, okay, here's 50 basis points. Our outlook for this year is 100. There's 2 meetings left. You do the math. And when Powell was asked, so what's going to happen at the next meeting? Very uncharacteristically for Powell, who always tries to talk down the SEP as not that serious, went, well, have you read the SEP? It's there. It's in the SEP. So the Fed basically, effectively, announced 100 basis points in cuts in September, all at once. And the market said, whoa. We have this election coming up. How are you this certain? This is way too much. You've over-indexed way too far. And they forced the Fed to walk back and readjust expectations. And of course, by December, they did. By December, they diluted the outlook for 2025 significantly. They diluted the outlook for 2026 significantly. And so I don't really think what the market was saying there was they were rejecting what the Fed is doing. They were saying, okay, we pulled the rubber band really far and you've overshot. And there's no way you know that you'll need to do all this. And of course, by then, the market was relatively optimistic about there being another Trump term because they figured the tariff talk won't be much of anything like it was last time. Instead, it'll be more about tax cuts and deregulation, and that's a pro-growth agenda. How in the world is the Fed supposed to cut rates in that environment? It'll be inflationary. They'll let inflation out of the bag if they go this big. So Fed goes really, really dovish. The market looks at the election coming up like a month and a half later and goes, no, this doesn't make any sense. So I don't think it was a rejection. I think it was looking at the Fed and going, you overdid it. And I think actually from the Fed's perspective, we've talked about Fed judo before, they wanted to overdo it. They wanted to break the back of speculation by throwing the markets for a loop and basically saying, oh, instead of us trying to fight you with these rabid speculative rate cuts that you're sticking in here, we're going to lean in and throw you off balance and kind of neutralize this. Let's fast forward to this year. Let's say the Fed cuts in September. If they do another 50 basis points suddenly, if they forecast something crazy going forward, the market may conclude that it's too dovish. And so you'd get that reaction again. It need not necessarily be that the Fed's policy isn't working. It could just be, much as it is now, a statement about the Fed's forecasting being something that the market doesn't agree with. I mean, we're there now. The market is plainly disagreeing with the Fed's forecasting.
What's the difference between rejecting and a statement that the market doesn't agree with the Fed's policy?
It does not. There's a very big difference. How are those
two different things?
No, they're hugely different. Because what you do for policy and what you are forecasting you will do in a year's time are very different things. If the market sees the Fed, for example, let's say the Fed cuts in September.
Yep.
And what you end up seeing is rates at the longer end go higher. But they don't surge like they did last time. They just adjust higher. Well, that would be, oh, okay, the Fed is going to respond to this growth scare. It's going to work. It'll be time to lift rates because the easing will have moved forward as the markets have wanted it. So the long end gets a little bit of an adjustment, and there is a shuffling of rate cuts forward because the Fed has finally decided to act. So the business cycle then at a 5-year, 10-year view is going to look better than it does if the Fed delays longer and lets whatever downturn fester longer. So if the Fed is more proactive, the view on future growth and therefore future inflation will be more constructive. So the view on future rates is going to be higher. That it's a matter of degree. To your point,
yeah, I think that will be. But what I'm trying to say is that's more painful for the real economy. So if the long end lifts, so if you get a cut, which was the expectation last September, everybody and their mother was saying, I'm going to get long bonds because they're going to cut rates. I don't know what your opinion was, but I think most people were saying that, and I was one of the people who were saying that's not going to happen. The long end is
by then.
Long end yield, I don't know. The long end yields are going to go higher, and that was my bet. That was my sort of contrarian bet. That everyone thinks that the Federal Reserve somehow has this magical power over the long end. They don't. They control the short end, and the markets have to price the long end. If the markets believe there's a supply and demand imbalance of long-term Treasury issuance, coupled with the lack of sort of trust that we're not going to treat our money like Tic Tacs, this thing is not going to do what everyone thinks it's going to do, and it certainly didn't. And you can say it was for some other reason, but that was my read then, and my read now is if long end yields go higher, it further exacerbates a housing supply and demand imbalance, which then further puts downward pressure, disinflation into the marketplace. That could be what the Federal Reserve wants, but I think from the way it will be read from the public narrative is that any cut where the long end, the whole yield curve does not fall, will be talked about as ineffective policy. But I've said for a long time, I think cuts are the new hikes. And I think that because cutting represents lack of protection of long end purchasing power, which means long end should demand higher yields in this environment, especially when we're passing $4 trillion bills. So I don't think it's a guarantee that people are clamoring for these cuts, clamoring for the cuts. And now they're saying, oh, there's 6 cuts priced in the curve over the next 2 years. And maybe we put a dovish Fed chairman in there. And I'm sitting here going, I don't know why you guys think this is so good. Like the long end is its own entity and can totally say F you and your dovish new chairman or your chairman who's cutting 6 times or starting in September. It could happen. And if that happens, there's a big read through that you just saw that whole playbook in September. And the most hilarious thing to me, Ilya, is everyone seems to have forgotten that the long end plays by its own music. And so we're going into the September. Now, in fairness, I actually agree with you. I think bonds probably can handle a cut in September. I do not think they would quote unquote reject it or display a different sense of policy. If he comes out with 50 basis points or something like that, like he did last September, I still don't even know what that would mean. I think there's more of a possibility that the market gets skittish this time. Goes like, whoa, why are they doing? I think that the market would get more skittish this time than it would last September. To me, it was a guarantee. The market's not ready for rate cuts. The long end's going higher. This time, I don't know that I put all those eggs in the basket. And the fact that home builders, if we can bring this all the way around, home builders had a effing sick day. Finally, and I'm breathing a sigh of relief, dude, because I've been talking about home builders on this network for like the last month. Every once in a while, I'll get this theme in my head and I'll bet on it publicly. And I'm basically putting my entire professional career on these stupid bets. And how home builders, I thought, this is an interesting moment to bet on the long end. And if it's an interesting moment to bet on the long end, and all these home builders are down 40 to 60%, and if long end yields will, fast or slow, they'll start to come down, that will ease the buying pressure in the housing market, and in some way allow some of these home builders to start adding supply, start bringing in new revenue, and I think investors will look at them differently. Today, you finally got a pretty decent jump in all this stuff. DHI was up nearly 4%. It was up more, but cooled off. Lennar was up 4.5%. I could go down the line on all these home builders, which finally got up off the map by 3 to 5%. To me, this is the vote of confidence. I don't want to do too much with one day. But my whole mindset is I think the long end will accept this cut. And if it will accept this cut, we're going to get lower long end yields. If we get lower long end yields, there are read-throughs here into what that means for home builders and just housing in general. And I think all of these little clues, I could be way off, all these little clues signal to me growth is slowing, to your point. Bonds are a decent bet. Home builders are cheap. All right, sorry. That was long-winded.
This is good. This is good because I don't think we have a fundamental disagreement here.
I don't either.
I think that we're basically looking at the same types of things. We're just kind of looking at it somewhat differently in terms of how we explain September. But I think the bottom line to our explanations is the same, which is to say the market either takes the Fed as too dovish or not. And if the Fed doesn't take the Fed as too dovish, if they do 25 basis points as expected, and they don't jump out the window on anything, because they did last time. They did way more than the markets thought, and way later than the markets thought. As long as that isn't how this happens, the market's going to absorb it. It's going to say, all right, you're going to walk down the long end from here. Bonds keep going up. I think the read through to home builders isn't perfect today because there was one other piece of news that was huge on this today. And that is that California rolled back some of the provisions in SEQA, S-E-Q-A. Governor Newsom has been trying to get this done forever. In fact, many governors have been trying to get this done forever. And they haven't been able to do it because there hasn't been any chance of getting it through California's legislature. Well, now they got it. And what this does is it basically rolls back some of the environmental linked restrictions on building in California. Initially, when Reagan passed this thing in the 1970s, when Republicans were the environmental party, let's not forget Nixon gave us the EPA in the United States, and Republicans in general, in particular California Republicans, like Nixon, like Reagan, were very kind of environmentalist in their thinking. And when Reagan passed this thing, it was intended to introduce greater environmental impact review on government work, government construction, government projects. And the way the law was written, a bunch of court cases subsequently figured out a way to get it to apply to basically everything and have it be used as a reason for NIMBY types to stonewall construction for all time and create a huge deficit of housing in the biggest, most populous state in the nation and contribute in a very outsized way to a wild housing shortage, which obviously we see nationally, but California is very much a poster child and a huge contributor because of its size, because of its population. And so what we see today is home builders get a reprieve on this finally. Decades in the making. This thing finally gets signed by Governor Newsom. They roll back a bunch of this stuff and clear the way for easier regulatory hurdle on construction. So this is obviously very good news if you're in the construction business. It's obviously also very good news if you, like me, and I think probably like you, think that we are terribly underinvested in new construction and in new housing in the United States in general, and certainly in California. And that's a huge reason for the affordability crisis, in particular in housing, that we just don't build nearly enough. And so this is a part of that home builder's story, and I think only reinforces the idea that this is an interesting buy. It's not the kind of buy that I would take on in sort of the tasty methodology. It's not something I would look at tactically. It's something I would look at longer term.
I agree with that. You actually can't, because the DH, we've talked about this a couple of times on the show, but DH Horton, DHI is like the biggest, most liquid of all the home builders. And you could drive a truck through its option market. So these pretty much, they have to be pure stock directional plays because all of their option markets are illiquid. Maybe you would do stuff like that, but like if its next 30 or 45 day cycle is a 30 cents to $1 or $2 wide, its leap is going to be that much worse. So you might, as long as you can get it, even if you can get in at theoretical fair value on a leap, they're going to take your eyeballs out if you're right. So I think that is one strategy. I would just say, for me, these have been pure stock plays, and it's purely because I have no desire to give up tons of edge to the marketplace and on entry, and definitely exit if I'm right. If I'm right, they're going to take my eyeballs out trying to get out of this stuff.
Yeah, I mean, if you were to, I mean, let's just see here. We can do XHB, we can do ITB. They're kind of comparable. So if we look at this and we say, okay, so let's say I want just a straight up. I mean, I don't think we even have options on the platform on XHB. Let's see if on ITB we do. So if we just went and said, you know what, I'm going to go just a long call option, just straight up a long call option, and I'm going to go out like, I don't know, until the end of the year, let's say. So I want to look at the January 16th calls, so early next year, and I'm going to do it here, like at 97, let's say. I mean,
it's about a 50-cent spread.
Yeah, it's not that bad.
No, it's not. But like as a percentage of the capital on each option, and then if you imagine you're right,
yeah.
So it's going to go deeper in the money.
Yeah.
You're likely going to deal with a little bit worse spreads. So you might be able to. What I'm trying to say is you might be able to get it executed at fair value, which is the midpoint between 830 and 880. But when you try to get out, if you've been right, they're going to take all 60 cents, if not more, on your exit.
They're going to punish you, but
so then that's 85 cents on a cost basis of $8. So they're going to take 10% toll from
right.
you.
So that's why the price you pay for not picking individual names and basically saying, I don't want to take individual company risk. That'll be what you'll pay for not picking individual names. I'm okay with that because I don't want to pick individual names. I don't want to pick individual names. That's not, I don't trust myself. I'm more of a macro and thematic thinker.
I think that's fair. These guys know I went down the rabbit hole one day on all the home builders. And I agree with you, because it added good, let's just say, headline value to the basket of names. Though home builders are highly regional, so there are some that actually didn't even affect them. But you had a bunch of stuff working today. So you had bonds that moved a little bit higher up to 115.5. You had a shift to small cap and value oriented over growth and momentum. These are all in the sort of the value bucket.
All of that helps.
Valuations between 5 and basically low double digits. So they're all a value bucket, which outperformed the market by 100 to 200 basis points. Plus, you had a little bit of sprinkled in headlines that were positive. So all those things I think were helpful. We'll see if it can. These guys are kind of getting sick of me talking about home builders. I talk about them so much. But it is a theme that I'm like, all right, nobody's talking about this. I think they're cheap, and I think there's a potential catalyst for movement here. And who knows, and so we got 5% off of it anyway today, which is a good start. We'll see if we can put anything behind that. Let's go on to the dollar, my friend. And then I want to talk about a couple of stocks, not as what does Ilya think about these stocks, but more so what does Ilya think about thematic risk-taking in sort of AI, defense, and some of these other things. But first, let's start with the dollar.
Yeah.
118, man, up and away. Dollar continues to get smoked. When does this train turn around?
This is a really weird thing now in the dollar, because depending on which currency you look at, you're seeing different things. The euro got stuck today. It tried, it couldn't make it. The pound has been stuck for a few days. And so I'm a little bit short that one, because for whatever reason, it isn't doing what the others are. At the same time, the yen's made some headway, and so has the Aussie. The Aussie is breaking highs. The yen seems like it's attempting to build some momentum, though it's a little bit more kind of congested. The Aussie is more obvious. And so I'm actually on both sides of the dollar here. I'm a little bit long the Aussie, started to nibble on the yen very very modestly on the spot side of things. And thankfully, we now have this in the platform. Hat tip, Tasty FX. If you thought the 6J contract was too big for you, as I have, then you now have dollar yen. You now have a way to trade spot dollar yen directly in the platform. I'm very much a spot trader. I love it. And so, in fact, that's my first love in markets. I sort of came up in markets in spot FX. So I've nibbled a little bit on the short side of dollar yen, that is long yen. I'm short the pound in the futures, micro futures, M6B. I'm long the Aussie, M6A, and I'm looking to see which way this thing is going to break. If this is last year, then what you saw was the dynamic you and I have talked about for a few weeks now. The Fed delays, the market goes, okay, so you'll need to do more later. There is an exchange rate there. Delaying now means every cut you don't do now is more than one cut if you do it a year from now because you're behind the ball. And the pricing in the market is starting to go that way. And the long end is going up, as we've discussed, would probably happen in this scenario. That is, the bonds are going higher at the long end to kind of reflect this delay. The dollar you would expect to weaken in this environment, but it already has weakened so extensively. I mean, frankly, it's papered over all of my sins in the stock market in the first half of this year. I'm up across accounts for the year so far, despite the fact that I got back short stocks way too early. Like, obviously, being short stocks worked from February to April. I got very briefly long off the Liberation Day bottom, and then I got back short way too early, and the market's been running against that idea. But I've been short the dollar since the beginning of the year, and that's really worked. Now I'm kind of looking at this and going, okay, hold on. This maybe is getting a little crazy because I'm not quite so sure that this gives way and keeps falling just because we have this dynamic in the bonds. I'm sort of suspecting that you might get a little bit of a different breakdown this time, where the dollar looks a little bit overshot on the downside, and if risk turns at a time when you've decided, look, it's ridiculous to worry about sovereign risk in the dollar, and I think that's what sort of April's reckoning was all about, that people thought, wait, is there sovereign risk in the dollar, like imminently now? And the answer is no. So I think you find now, maybe, and sort of this is kind of where I think we're angling, but I'm obviously not that sure because I'm on both sides of the market, is a scenario where bonds go up, stocks decline, and the dollar catches a haven bid and corrects higher. Maybe not against the yen, if it is a true risk on and off dynamic. The yen I would expect to be an exception, as it sometimes is. But by the way, when you get correlation one risk aversion, the dollar and the yen typically rally together against everything. So I'm kind of expecting to go there, but I'm not terribly sold yet.
I could see it. I could see two of those things for sure. I like the risk reward of betting on the downside, or the reversal of fortunes in the dollar. I like the risk reward betting on the upside in bonds. I'm just a bit gun shy to bet against risk in the market, though. You know, I don't
wise.
know.
I have not been gun shy to my own detriment.
I mean, if we were at 6,500, Ilya, I would start going like, I've got to take this shot to the downside. 62, I don't know. I can see us hanging around. Though I don't like the value here. I'm going to be honest, which is why I'm talking about home builders. I'm trying to find something that I like, that I feel like is worth buying, and everything else I don't like. I think at cheap vol, I like the idea of replacing a lot of my long stock exposure with cheap call premium to maintain upside exposure but minimize any downside risk on a fat left tail move. I like the idea of potentially buying sort of cheap insurance to the downside. But I think one of the things that is most interesting to me is like, I used to work with this guy, and he used to say, if you're a CEO of any company, here's what you don't want. You don't want to wake up in the morning and Amazon is in your business. What he meant was, there used to be these announcements like, Amazon's going to get into the health insurance business, and then all the health insurers would crater like 10% because Amazon has this gigantic scale. Or Amazon's going to deliver a new Peloton, and then Peloton would crater because why wouldn't you buy, it's just a bike with an iPad strapped to it. Why wouldn't you buy that cheaply from Amazon versus pay for this brand premium? So he used to say this every time Amazon would make these announcements. I feel that way about China. Whenever China wants to get into a business and become the low-cost supplier, they will do it, and they will drive margins down to zero because they have that capability of scale, labor, resources, and et cetera. And over the last 2 days, man, there's been, what was it, Baidu? I want to say yesterday, is today Monday? I don't know. Baidu, I think yesterday open sourced some of its AI models, and today Huawei said it's going to open source 2 of its AI models. And so they are effectively doing what OpenAI said they would do, but then pivoted in doing when they realized there was massive profit potential behind this. And like the idea that these gigantic Chinese companies are going to put out quality AI models that are completely open sourced, to me, I go, well, what the hell does that mean for our whole financial market right now, which is basically on the back of AI stocks? You know, it feels like there's this clear desire from, I don't want to say it's a desire from China, but clearly that presents problems for a financial market that is so AI heavy that there's this competitor nation state that's putting out stuff at open source. Clearly that minimizes value. And so that is a way where I can get into your camp, which says if they pop this AI thing just a little bit, they're letting the air out of all the tires, man.
Right. And by the way, they don't have to, it's not like what they have to do is change the narrative and say, actually, all this AI stuff is nonsense. No, all they have to do is bring the markets to the conclusion that the feverish build-out optimism, that phase of the hype cycle is over. So consider, did the dot-com bubble bursting derail the great and powerful internet future? Obviously, the answer is no. Did the popping of the railroad bond bubble at the turn of the century derail the building out of railroads and the ushering in of the U.S. into the industrial age with that build out? Obviously, no. Did the popping of the warrants bubble mean that the U.S. or the nascent colonies that would become the U.S. didn't amount to a huge economic opportunity? No. There is phasing to this stuff. And the first phase is, oh my God, this is going to be awesome when it happens. Hype cycle, speculation, huge valuations. Then that hype cycle meets reality, and reality goes, oh, okay, you thought this was going to happen like tomorrow, but that's crazy. And then there's a come down, a redistribution, a new set of champions emerges, the longer term narrative resumes at a reasonable clip.
Which portion of this do you think do you think we're still in the hype cycle?
I think we're still in the hype cycle. I think we're in I think the market really is trying to suck everybody into buying pets.com before the Super Bowl commercial. And I think the Super Bowl commercial is closer to coming than people think. And what we're going to end up with is all of a sudden people are going to go, pets.com at the Super Bowl. Okay, this is wild. and there's distribution.
Especially because we went the OpenAI and NVIDIA route of hyperscaling instead of, let's say, the DeepSeek path of like ultra efficient models. And maybe you needed to do scaling before you could find efficiency, but either way, it does seem like there are
them to go big for them to do it.
Right, that's what I'm saying. That's what people. That's what some would argue.
I mean, I am by no means an expert in the nitty gritty of building LLMs, but from what I'm reading, it sounds like, in particular, Meta had to put all that stuff out there into the wild, open source, so that players like a DeepSeek could go, oh, okay, I get what's happening here. Now I can go do my efficient thing, and I can iterate from this.
Let's go messy again. So we started with, we're making a little sandwich here. We start with messy as our slice of bread.
Messy sandwich.
Then we went meat substance, and now we're going to put our other slice of messy bread on our sandwich here, which was
soggy Wonder Bread. Here we go.
Powell was testifying, and they brought up whether or not he would have lowered rates if it hadn't been for tariffs. It's kind of like that Scooby-Doo episode. It would have worked if it hadn't been for you rotten kids.
Yeah.
So I'm going to read this excerpt just from CNBC article because I think it does a good job of breaking it down. But when asked during a panel if the Fed would have lowered rates again this year had Trump not announced his controversial plan to impose higher levies on imported goods earlier this year, Powell said, I think that's right. In effect, we went on hold when we saw the size of the tariffs, and essentially all inflation forecasts for the United States went up materially as a consequence of tariffs, Powell said at the ECB forum in Sintra, Portugal. I said in front of Congress. In front of ECB.
Well, he said something very similar in front of Congress.
Yeah, he did. You're
last
right.
Week.
He did.
Same thing.
So you're kind of. I've long said that they're both pointing at each other. Trump is pointing at Powell, saying you're too late. This is your fault. And Powell's pointing at him, saying, "Well, you threw in these, you threw up that foam board in your tariffs, and we gotta wait. This is your fault,
bro. Why did you have to bring the foam board?"
What do you think about the jawboning that's happening from the bully pulpit of the presidential office towards Powell, and the jawboning that seems to be coming a bit more respectfully, of course, from the Federal Reserve back to the president? And what's impacting monetary policy? Your thoughts on jawboning going both ways?
I think, this should surprise no one, but I think what Powell says makes some sense if you look at it in isolation. So if you look at kind of, here's what Powell is saying, is it logical? Inflation is at 2.4%. It's much closer to target than not. The jobless rate is 4.2%. By historical standard, that's very low. Not the absolute lowest, but definitely sort of toward the low end of what is normal. Why would you want to make a big policy decision right now when you've got these tariffs looming in front of you and you don't know what they're going to do this time? And the Fed has been very clear. They don't know. But historically, there is a pass through to inflation from similar things. There is a knock to growth from similar things. But as far as your mandates are concerned, if you're the Fed and you go, okay, my opinion is worth nothing. I have a mandate. I'm not trying to express an opinion on policy outcomes. I'm trying to get to my mandate. And neither side of my mandate is overtly flashing red right now. Why wouldn't I wait? Why wouldn't I get as much data as I possibly can while I can before one of these things is screaming at me which way to jump? That's not illogical if you take it at face value. If you take the president's position at face value, it makes sense. Which fiscal authority ever has not wanted cheaper government borrowing? In fact, you and I have talked about kind of the history of fiat systems, and it's all the same. Fiat systems historically fail because the government gets its hands on the money printer and goes for short-term monetary expansion at the expense of what then becomes catastrophic inflation. What has kept the modern architecture more durable is virtually every major central bank around the world has embraced the separation of fiscal and monetary policy and made its central bank some version of independent and disconnected from the electoral fiscal cycle to try to prevent politicians on a 3-year, 5-year, depending on country, 6-year, 4-year electoral cycle from getting into monetary policy in a direct way. And we've also seen what happens when that isn't the case. In Turkey, we have seen an absolute catastrophe of inflation that the government has made by having the government directly involved and basically browbeating the central bank. So it is not at all shocking that the president wants lower rates. If you read the memoirs from Paul Volcker, you know that Reagan did the same thing to Volcker. He just didn't do it out in public and on social media. Bill Clinton did it to Greenspan. This is not unusual. Governments want cheaper money to do the things they want to do. So if they feel like the Fed isn't giving them what they want, they're going to snipe at it. Fine. The Fed was made independent expressly to prevent that sniping, which was judged as inevitable. If you read about the founding of the Fed, they really wanted to make sure to cut the Fed off from this so that the sniping happens, but there's no action, that the Fed can independently do this. Shout out the great Paul Warburg that thought this out. One of the great economic thinkers of modern times. What's interesting about this episode is that the markets agree with the president for their own reasons. But they are also screaming at the Fed that the Fed needs to cut. And this is where the sniping gets interesting, because the Fed obviously sees what the markets are asking. And so for the Fed, this becomes a really delicate dance. And for the White House, this becomes a wonderful opportunity to shut up. Because the more that they go public about this, the less the Fed is able to do. Because the Fed does not want to compromise its credibility by appearing to kowtow to political interference. Because if they do, they can't conduct policy credibly. And then the whole thing falls apart. Then the markets go, oh, you're not an independent central bank. Everything we know about the Treasury market is wrong. Everything we know about the dollar is wrong. Dump it all around.
I don't know, man. Didn't this happen? He browbeat him into the public perception could be that in Trump 1.0 that Trump browbeat Powell into lowering rates back then too, and it didn't. Everything didn't unravel after that.
I don't think that's what happened. I don't think that you could have that perspective, but I don't think that that's. I think the economic data was unmistakable then. You could look at it and you go, the Fed is cutting for these reasons. Look at it. There it is. And the Fed was resisting then. When the president wants lower rates. He's not shy about it. He's been wanting them since before he was president. He wants them regardless of circumstance. He will want them until the end of time. He's made that clear. So back then, the Fed resisted, then the economic data turned, and here we are. I mean, let's not forget why.
I think that's what's going to happen here too. I think that's what's going to happen here. I think by September, unless, and this is the caveat, unless we get some crazy hot inflation print between now and then, which I don't think is a non-zero chance. I think the base effects make that possible.
Well,
but unless that happens,
Powell was looking for it, it seems.
Right. And so unless that happens, I think what likely is the case here is the same setup here. He gets browbeat until the data becomes undeniable. Then he has to cut, and it looks exactly the same as basically what happened in Trump 1.0. You can have the interpretation that the president effectively bullied him or jawboned him into doing this, or you can have the interpretation that the Fed resisted long enough until the economic data provided the opening. But I think it's the same exact setup as we saw in Trump 1.0. I guess I don't see much difference. Let me say it that way. I don't see much difference.
So I think that even a broken clock is right twice a day. When all you do is scream rate cuts, for all time, regardless of circumstance, eventually it'll be time to cut rates.
Right. But what I'm saying is, I think it plays for them. Here's what I think. I think they think it plays for them politically, because if the president is screaming that, hey, I'm passing these bills, I'm securing the border, and the only thing we needed was this guy over here, and whatever expletive he's using to describe him, he's not doing what he's supposed to do.
I think is what
so then what happens is, by the time you get the economic data that supports needing to cut, think about what that is. That doesn't play in the president's favor. That's probably unemployment ticking higher. That's lower growth numbers. So that's going to be headlines or narratives that the president does not want to accept as part of his policy. So what he's doing right now is he's telling everybody that, hey, all the stuff I'm doing is great. This guy's going to wait too long, so that when those headlines come of either slower growth or higher unemployment, he's got his scapegoat. And then eventually he's going to get his cut, and then he's going to be able to say, like, hey, look, now that he's cut, now you give me some more time and I'll show you what this is going to do to the economy. I think it plays for him politically, which is why he's doing it. So there's the argument that, if he would shut up, you might get your cut sooner. But I think he cares. I think the scapegoat aspect of this is more valuable to him, and he knows he's going to eventually get the cut anyway. That's the way I interpret what he's doing.
We've known, right? The Fed, he even said it today, right? He said in Sintra, there's an overwhelming consensus amongst the FOMC participants that we're going to need to cut this year. He said, vast majority thinks this year we're cutting. They've been saying that they're going to be cutting this year forever and a half now.
Mm-hmm.
So there's no shock there. Very clearly, they're walking back what they themselves were forecasting as far as how many rate cuts would be necessary. So in a sense, the Fed is disagreeing with the president, but it's also disagreeing with itself, because it too thought there would need to be more cuts. And now it sees this tariff thing and goes, oh, man, we want it to be cutting by now. But who knows what this thing is going to do? It keeps getting delayed. And by the time it actually filters into the real economy, who knows where the inflation incidence on this actually hits? If, let's say, it was held in April, as is, maybe we'd start seeing it. But it was delayed by 90 days. And then China, which is arguably the biggest piece of the whole thing, that gets delayed even further. We have to wait until August for that, maybe. And then maybe we see what the actual architecture of the tariffs is, and then maybe we'll see what the actual shock or not shock is going to look like. Who knows? So while the economy isn't screaming, holy Jesus, inflation risk, or on the other side, oh my God, recession, why don't we just back up here and not make a terrible mistake and not make a bad situation worse? That makes sense. At the same time, and this is where I think sort of the sniping kind of obscures what actually matters. The market is telling them, hey, you there at the Marion Eccles building, our collective wisdom says that there is a growth downturn that's here, that the risk from the tariffs is in the demand destruction. And we're already reading through to that. Forget inflation. This isn't going to be a nice sequence where first the inflation goes up, then everybody doesn't like the inflation, then they retrench on spending, then there's a downturn. No. We're skipping to the downturn here. And you look at the ISM numbers that came out today, the input cost structure for manufacturers is bonkers. Second quarter ended up being the fastest input inflation for manufacturers since 2022 mid-year. That's the peak of post-COVID crazy. So it's not like the inflation from the tariffs isn't there. It's there. It's just not reading through to consumer prices yet.
Mm-hmm.
That takes time. So do rate cuts.
Or it gets factored, or it just hits margins.
Yeah.
Right. Yeah.
Well, and we've seen that. The PPI data has shown us, for example, in April, there was a big hit, and so they just ate it and said, you know what, we're not going to pass this on to consumers.
All right, let's go to the messy. Let's put an extra slice of messy bread on here. I'm sort of.
It's a Big Mac of messy.
It's. So we got 5 minutes, and we haven't done much of the trade talk stuff in a while.
Yeah.
Because there isn't really much to talk about. There's just a bunch of, hey, we've got these deals on the table. We're finalizing these deals. We'll be announcing these deals. It's a bunch of that stuff.
Yeah.
But I was sort of fascinated by the gamesmanship that took place between the U.S. and Canada over the last week or so, which was
Are you not entertained?
One, Carney is shit. He promised the Canadians a pit bull. He is a chihuahua at best so far. I think Friday, I guess these guys ran into each other, had a conversation. It seemed like they were getting close to wrapping up some sort of agreement, but their digital services tax went into effect the 29th. What was that Sunday? It was supposed to go into effect, I think, on Sunday.
Yeah.
This digital service tax was basically going to be 3% of revenue taken from Canadians. I love this concept, by the way. This is how you would if you wanted to do a global tax, sort of wealth tax, this is something similar to how you would do it, but 3% of money above $20 million taken from Canadians would be taxed. And so this would have had impacts into like Google, Apple, Amazon, Meta, Alphabet. And so Trump effectively said, all right, we're walking away from trade talks with you guys. If this and Carney and the Canadians, they pulled the digital services tax.
Yeah.
So we effectively protected our gigantic digital monopolies against one of our close allies and geographic neighbors. I'm curious. What did you think about that gamesmanship, man, and what it says about Trump, how far he's willing to go to protect American companies, American businesses from foreign tax, while we are trying to collect a rake from the rest of the world. We're trying to collect a 10% rake, and Canada's going, okay, well, we're going to collect 3% on this stuff, and they're going, no, you're not.
No, you're not. No, you're not.
Your thoughts on the gamesmanship back and forth?
Couple things. First of all, you and I know this, but let's just make it clear for the audience, because I don't think you and I have any kind of disagreement about how this works. When we say there's a 10% tariff, we're not trying to extract that tariff from other countries. We're essentially saying to U.S. importers, if you want to sell stuff that's made abroad, you have to pay more. Because you can't make another country pay you a tax. The tariff is a tax on imports, and the only people you have jurisdiction to take taxes from are your own citizens. So you're taxing importers, domestic importers. So if you were taxing the importers of Scotch whiskey, you would not be taxing Lefroy. You would be taxing the U.S. distributor of Lefroy.
Sure.
So
I agree with you 100%. I actually think all taxes work like that. For example, if you're going to if Canada puts on a 3% tax, then it's going to change the revenue models of these companies in Canada,
Right.
and somehow we all end up paying all of these things at the end of the day. But I agree with you.
Yes. So that's one thing. That's just so folks kind of follow along with what we're saying. Canada's digital tax is very much like Europe's digital tax. They did the same thing. And what the timing of it, because this has been in the hopper for a few years, this digital tax. This is a Justin Trudeau thing.
Mm-hmm.
And Carney basically, it looks like, made the call. Why is this the hill I'm going to die on?
Mm-hmm.
Justin Trudeau is terribly unpopular. He did this basically following on the heels of Europe as a negotiating tactic for Trump 1.0, to kind of create leverage, to basically say, we're not powerless. This was sort of part of what him and Chrystia Freeland were coming up with when they were renegotiating NAFTA into the USMCA the first time. And Carney said, okay, well, if this whole thing is basically a leverage button, then for me to die on this hill would mean that this is a policy priority and not a negotiating maneuver. If I let this then break the negotiation in which this is supposed to help. So you know what? The hell with this thing. This was Justin's thing. He can have it. This is not a policy perspective I ever signed up for. I'm just going to go and negotiate with Trump directly. And we're going to see what we do. So I thought it was actually a pretty deft maneuver for Carney, because I think things have been going pretty well in his conversations with the president so far, it seems. Notice the 51st state talk is gone. The president is not trying to antagonize Carney the way that he antagonized Justin Trudeau. So I think from Carney's perspective, he was like, look, here's low-hanging fruit. And Carney is not exactly a scorching left winger. I can see him be a kind of economist in the classic sense, going, you know what? Anytime you can avoid an extra unnecessary tax that distorts incentives, creates deadweight losses, and saddles consumers with nonsense, let's not. And so it was kind of an easy thing. You get rid of this, you placate the president, you let him do his thing, you make him feel good, sort of like Keir Starmer brought him a letter from the king. Every now and again, I go back to that video where Keir Starmer presents him with the letter, and Trump is just beaming there, and Starmer's like, this is a really important letter. See? I brought you a piece of paper. It's real shiny. I think I didn't make more of this than Carney just basically saying, I'm not going to do the Justin Trudeau playbook. I have my own, and here is an easy layup where I can just kind of say, okay, here. let's get a good deal. I didn't really think that there was more there.
To your point, though, I think Trump in this whole melee. I think on Sunday he went on a Fox, or he had an interview. I think on Sunday where he once again, for the first time during the Carney administration, said the 51st state line.
Oh, did he?
Yeah. But obviously,
they had to get rid of the
yes, correct.
Tax. They were like,
clearly
right,
they've got some
whoa.
gentlemen's. Clearly, that was like something I would bet Mark Carney had sort of a gentleman's agreement at the very beginning. Hey, let's get on these terms. Let's stop referring to Canada as a 51st state. Let's stop referring to me as a governor. And then in exchange, we can have these good faith negotiations and work towards a better understanding. And so clearly he hasn't said that. And now they get into this spat that he walks away from the trade table or the negotiating table on trade talks, citing the digital services tax as the reason, and then on Sunday goes on Sunday shows and says Canada, frankly, should be the 51st state. So he goes back on that.
Yeah.
And
So
then
he throws a hissy fit, and Carney goes,
oh, bro, we live in a simulation. All right, man. It's always fun. We covered a lot of ground today, and I told you we would. I had a lot of fun with this conversation. I really appreciate you imparting your wisdom and your opinions. If people want more of both, tell them where they can go, Elia.
As ever, I am all over the PM schedule on Tasty Live. It's overtime, then it's macro money once a week. We're here for this show. It's on Tuesdays. Sometimes it's on Wednesdays, but once a week, sure as daybreak, we are here. I am all over tastylive.com and writing all the things I talk about down into articles. So if you don't want to hear me talk at length, you can read me in brisk format and take issue then. I am commenting at Ilya Spivak on former Twitter and on Blue Sky and wherever else I get a chance to mouth off about this stuff.
Right on. Ilya, always fun. If you want to follow me on Twitter, you can do so at Victor Jones. The O in Jones is 0 because I like to be difficult. I'll be back with you tomorrow. It's just tomorrow's our last day, right? There's no.
I think so. Yeah.
We're not doing shows on Thursday and Friday.
Yeah, those of us that live in the PM world,
yeah.
I think there are shows on the Tasty Live network on Thursday, but the cutoff is 10 a.m. Central.
Yeah.
So
I think tomorrow's going to be our
tomorrow.
Synthetic Friday. Yeah. So I'll see you back here for this week's last show with Chris Vecchio, Ilya Spivak. I really appreciate you coming and hanging out for a while. All of you, hit the like button on your way out the door. Subscribe to the channel if you haven't already. We'll see you back here tomorrow. Till then, peace.
Peace.